This is an attack on the independence of the Fed.
If there is a disruption to the Fed's independence, we are in a slippery slope.
One of the keys to the U.S. financial market is the independence of the Fed.
It's so obvious, the negative ramifications of this. But given the unpredictability we've seen in this president, anything's possible.
The end result is that we're all asking huge, major tectonic shift questions.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday with the pressure building on Fed Chair Jay Pyle, as President Trump warns the economy could slow unless, quote, Mr. Too Late cuts interest rates, the tension leading to a rethink on Wall Street. Barclays writing the live prospect of reduced Fed independence unlocks dollar risk too large to ignore. The dollar moves already too large to ignore. The greenback heading towards its biggest monthly decline since 2009, helping to push gold to another all-time high.
And it's come so much quicker than so many people think. A number of commodities analysts have said that they've really had to bring forward their expectations and their price targets on gold. Look, there's a real question about how much what we're seeing in markets is due to the belief that truly Jay Powell will be removed from the Fed chair position. But there's another belief, which is that policy uncertainty in the United States is undermining dollar-denominated assets, regardless of what happens. And it doesn't really have to do with Fed Chair Jay Powell as much as a constant threat to some of the bedrocks that people have relied on.
We've seen that in the price action of the last 24 hours. Bond yields higher, the dollar weaker, gold a whole lot stronger over the year so far. Gold has absolutely ripped. And a lack of clarity about policy in the United States are the epicenter of some of those moves.
Lack of clarity when it comes to tariffs. I've seen a number of notes, most notably this morning from Lori Calvasina of RBC saying the fog of tariffs. How many analysts are putting out the fog of tariffs? On top of that now, they have the fog of who is going to be the Fed chair. Right now, it is Jay Powell, but Trump continues to double down, calling him Mr. Too Late, saying not just cut rates, but I don't think you're the right person for the job. This morning, Jonathan, Wall Street Journal editorial board, smart presidents may pay attention to market signals and adapt. The adaptation now would be to negotiate a quick end to the tariff barrage, claim some trade deal victories, and call it a day.
Let's pick up on one of those lines. The president's doubling down. The risk is the Fed digs in. And this is a point that B. Mosey and Lincoln made just yesterday. The Fed digs in to protect institutional credibility and doesn't move when maybe they should move.
Yeah, and this also goes to the question of exactly what the role is going to be, not just of the Fed chair, but everybody else, right? Have people dug in on the Fed to try to say, look, we're not going to cover your mistakes. It is not our problem. There also, though, is the uncertainty of if the Fed were to move at a time where the move has come in real rates, not break-even rates, not the front end, how much do they create a liability for themselves that they can't put back in the bottle if, say, there are deals reached, which is the expectation. So there is a question of the political perception in addition to the monetary reality, which is very unclear.
There's a little bit of stability in the tape this morning, at least. Equity futures positive by 1% on the S&P 500. In the bond market, the 10-year just about unchanged. The 30-year yield down almost a single basis point. Coming up through the next 60 minutes, Brian Levitt of Invesco following a rough day on Wall Street. Brian Gardner of Stifel as the president says tariff negotiations are going well. And Krishna Guha of Evercore as the pressure builds on Fed Chair Jay Powell. We begin this hour with stocks bouncing back. Brian Levitt of Invesco writing markets have struggled as investors assess ongoing changes to the nation's policy approach. It's difficult to put plans in place without knowing the rules. Brian joins us now for more. Brian, good morning. Good to see you.
Good morning. Good to see you,
You're
too.
usually constructive, bullish. Does this feel different to you?
It does feel different to me. I mean, the reason that I'm usually constructive and bullish is in most years things get better relative to expectations. And this is a year where things are getting worse relative to expectations and policy uncertainties are mounting on top of each other. Now, it's interesting, Jonathan. People usually ask me when I'm so bullish, well, when do you get bearish? When does the volatility come? When does the drawdown come? And invariably throughout my career, I said these things don't emerge out of nowhere. They're almost always the result of policy uncertainty. And we're sitting here now. Typically, when we have policy uncertainty, you can start to see things that'll get you to sense that policy direction is going to change. And right now, we're really more on the whims of the White House and waiting to see ultimately what that's going to look like. So it's hard for markets to get a footing in that type of an environment.
It's leading to a rebalancing away from dollar-denominated assets. We've seen that through the whole of the year so far. Is it anything more nefarious than that, a rebalancing following a decade-plus series of years of outperformance for US assets.
I would say right now it's a rebalancing. I mean, if you think about where the dollar was incredibly strong, and money's going to flow to where it's treated best, right? And so rates were above the major trading partners in the U.S., growth was better. So no surprise that the dollar was as strong. It was expected that over time, as U.S. exceptionalism started to narrow with the rest of the world, that the dollar could moderate some. But we were hoping it was going to come from better growth outside of the United States. To see it happening amid policy uncertainty, that's more problematic. Now, I wouldn't say it's the beginning of a collapse in the dollar or the end of the reserve currency. It's a move that a lot of people had expected, but really coming from a direction that's different. Most of us thought it would be a broadening out, a recovery in the major parts of the world as central banks started to ease, particularly in Europe and in the UK.
If it weren't for the policy uncertainty, you sound unabashedly bullish. You said at one point, I'm confident that the U.S. economy is strong enough to adjust to different policies. Yeah. It's just the uncertainty therein. So what does being bearish for Brian Levitt, a FOMO kind of guy, look like?
Well, the setup coming into the year was good. Right? We had a strong economy. We had stable inflation, but at the upper end of the comfort zone. So you add that together, that's good nominal growth, which is supportive for corporate profitability. So the setup was good. The challenge that we have now is we've seen a valuation adjustment largely in the more expensive parts of the market as a result of the policy uncertainty. We don't have a market that's set up for recession if you look at it in credit spreads or you look at it in equity valuation. So my concern, what does bearish look like? My concern is that the longer the policy uncertainty persists, the bigger the hit to economic activity. You'd have to bring down earnings expectations, but at the same time, as we threaten Fed independence, we're seeing interest rates creep up, which could be a hit to valuation. So we're down 18, 19% peak to trough, most of that driven by the largest names, but multiples are still elevated. So you would have to see that come down, assuming the policy uncertainty persists. I mean, we've joked it's hard to even plan for a podcast right now. How do you plan to build a factory, right?
Amen to that. There's this question about how long this can persist before you get certainty of the uncertainty. You get certainty about some of the ramifications from that policy lack of clarity. Do you have a time frame in mind where suddenly the 6% drawdown on the S&P 500 since Independence Day or Liberation Day doesn't really look like it's adequate to compensate for some of the actual economic damage?
Yeah, I think we're starting to see that. I mean, the longer this persists without trade deals, the longer we're concerned about whether the Federal Reserve could actually respond. I mean, for 40 years, the Federal Reserve has been able to respond to weakness in the economy. The longer that goes on, the bigger the challenges will persist. Now, what's the more positive side of this? How can we bring this back to intermediate or longer-term investors? The reality is these things can change on a dime. You saw it on April 9th, where we got a 90-day pause, and you had the third best or fourth best day in the market since 1957. You miss those days, it's going to be have a significant impact on your portfolio. So what do you do about it? The way I like to think about it is it's critical to try and bring down the valuation of the overall portfolio. So outside of the United States, more value-oriented stocks can help. The nice thing about that is in a recovery, those parts of the market should do well also. So I think that's the way we handle it. We hedge against risks. You talk about non-dollar exposure. We see what's happening with gold, but we got to be careful not to think of it as an existential long-term crisis. Ultimately, I think we're at peak policy uncertainty, and then
are we? I've heard that so many times. Isn't uncertainty part of Trump's grand plan of being a maximalist negotiator?
Well, I think we thought that you could be right, but I think we thought that in 2018, where it felt like we were never going to come to the other side of it. We got a 90-day trade pause. Fed backed off their tightening cycle. And
this feels different, though, Browne. This feels like this administration is pushing for a massive realignment across several dimensions. Do you not get a sense of that? Now, you can sit here and say that maybe they won't be successful. Perhaps they'll give up. But isn't that the objective?
Well, we don't know because we've seen fits and starts with it. So we've heard from some administration officials that that is the goal, and then we've seen the president adjust course on it. So, you know, there's still hope that there's going to be negotiated deals out of this. But yeah, again,
they're pushing back repeatedly against the whole post-war system.
Yeah.
Read what Stephen Myron is putting out there, the chair of the economic advisors. Now, again, you can sit here and say, I don't believe them. But that's what they're saying on the record. And at times I feel like we're sitting around the table talking about the weather at a time when they're trying to rethink the whole solar system. Right. And I think that affects you directly. For a long, long time, dollar assets were at the epicenter of the universe. There was this structural bid into them every single year. And the people that were just saying up and to the right weren't really putting their finger on why that was happening. This administration is pushing back against that. Should we have to rethink what all of that means for tactical asset allocation, the dollar's role in the portfolio, what treasuries offer me? Will they provide that ballast going forward if I have to rethink that and go somewhere else? Isn't there something bigger happening here?
We've become way overexposed to the United States as global investors, and some of that was by design, American exceptionalism. Some of that was just by market moves. And, you know, there's these statistics where more people were buying Bitcoin than the IFA index ETF over the last 10 years, right? So we understand that we were offsides with regards to that. So yeah, I do think it is time to rethink portfolios, to think about bringing down the overall value of the portfolio. You know, I don't expect, I think bond vigilantes still exist. I'm with James Carville. I still think they're going to intimidate everybody. I still think ultimately we're going to have to respond to higher interest rates. And so I don't see rates getting way out ahead. But yeah, it's a rethink, and investors should reallocate appropriately.
You hit it. You think the bond market is still the biggest constraint over any possible ambitions down in Washington?
We saw it on April 9th. I mean, I took off for Los Angeles in the morning, concerned that the bond market was showing significant cracks. Thank God for in-flight Wi-Fi, because I was able to get the alert that we had a 90-day pause. Otherwise, I would have wasted 5 hours of work. So we see it. You know, Carville said, I'd like to come back as the bond market so I can intimidate everyone. I still kind of question that. I mean, I'd still want to be like Springsteen or Tom Brady or somebody like that. But he wants to come back and intimidate everybody. That's precisely what the bond market does. And right now you've got vigilantes on all sides. I mean, it's very rare to have equity market, bond market, and currency vigilantes on all sides. And, you know, ultimately, I think the policymakers are going to respond to it.
The market's pushing back. Browne, it's good to see you.
It's good to see you,
as always.
too.
Thank you, sir. Browne Levitt there of Invesco. The bond market is settling down. The 10-year yield just about unchanged today, 441 on a 30-year maturity. 490 is the yield at the moment. With an update on stories elsewhere, with your Bloomberg brief, is Danny Berger. Hey, Danny.
Hey, John. Pope Francis' funeral has been set for this Saturday at 2 p.m. Eastern Time in St. Peter's Square. A viewing of his body will begin this Wednesday in St. Peter's Basilica. President Donald Trump said he and the First Lady would attend the funeral, embarking on the first foreign trip of his second term to honor the late spiritual leader. Elsewhere, President Trump says that U.S. Defense Secretary Pete Hegseth is doing a great job despite what appears to be attacks from disgruntled employees. Hegseth is facing a staff churn, a leak investigation, and a report that he shared sensitive military attack plans in a second unsecured chat group. President Trump also met with some of the nation's major retailers at the White House as executives sought relief from tariffs. Bloomberg reporting that the meeting included representatives from Walmart, Home Depot, Lowe's, and Target. Spokespeople from both Walmart and Target called the meeting productive. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on this hour. Up next on the program, Trump's confidence in the economy.
The economy is very good. We don't have inflation. I think we're doing really well. We're all set. There's a little transition, and that's going to happen. But ultimately, we're going to be the strongest that we've ever been.
That conversation up next with Gardner of Stifel, live from New York City this morning. Good morning. Equity futures bouncing back by 0.9% on the S&P 500. Stuart Kaiser of Citi. The path of least resistance is lower. Yesterday we were lower by more than 2%. Doesn't even make it into the top 3 for the month. Down more than 2%, desensitized to these major moves we're seeing in the equity market. Major moves lower over the last month. The Nasdaq bouncing back by, let's call it 1% this morning. Under surveillance this morning, Trump's confidence in the U.S. economy.
We're going to ultimately have a deal with anyone. The economy is very good. We don't have inflation. Energy's down at the lowest it's been in years. We hit actually $1.98 recently in a couple of states. I think we're doing really well. We're all set. There's a little transition, and that's going to happen. But ultimately, we're going to be the strongest that we've ever been.
So here's the latest this morning. President Trump saying tariff negotiations are going well as he continues attacking Fed Chair Jay Powell and calling for lower interest rates. Joining us from the nation's capital, Bloomberg's Tyler Kendall. Tyler, doubling down on the Fed chair and also coming out repeatedly suggesting we're getting closer and closer to trade deals. How close are we?
Yeah, John, good morning. Well, that's one of the big questions here. We are seeing some positive signs, including that Treasury Secretary Scott Bessent is expected to meet with his Japanese counterpart here in Washington later this week. We also got a significant readout after J.D. Vance met with Indian Prime Minister Modi just yesterday, saying that they have confirmed a finalized roadmap for a deal. It's really, though, still leading to a lot of uncertainty here, as Jerome Powell indicates that the Fed will remain in wait-and-see mode amid the tariff fallout. And President Trump really ramping up his attacks, going even further yesterday to suggest that the U.S. economy may slow if the Fed doesn't cut interest rates and fast. Mark Zandi of Moody's Analytics was on Bloomberg television yesterday, suggesting that the Fed chair's job has never been harder because the central bank is caught between a rock and a hard place when it comes to inflation and weaker growth, not to mention all these uncertainties about a trade deal, because we know it takes time to clinch them, let alone in 90 days. John, the latest reporting is that we could expect potentially a court case to be decided this week that could have far-ranging impacts on the Fed as the Trump administration seeks to overturn legal precedent as it ramps up its attacks on Jerome Powell.
Tyler, when it comes to the trade deals, is there a sense from U.S. trading partners that they're walking away from meetings understanding exactly what the U.S. wants out of these agreements?
Yeah, Annmarie, it depends on which trading partner. There is still a lot of ambiguity here, even as Bloomberg News reports that the administration is getting ready to push our trade partners particularly hard when it comes to what concessions they can make on their own trade with China. But take Japan, for example, considering that country has been given priorities in these talks. We are watching a few threads here as President Trump really doubles down that those non-tariff barriers are going to be incredibly important in these conversations going forward. Japan, for example, has already pledged that it will boost U.S. LNG imports, but we know this White House would like to also see them make firmer commitments when it comes to agricultural imports as well. And President Trump really doubling down on the idea that he would like to see a lowering in standards when it comes to U.S. auto imports into the country, alleging that stricter standards has made it more difficult for U.S. automakers to access that market. So we're really going to have to see moving forward here which of these countries can clinch that trade deal. But it's clear that the administration wants to focus on those non-tariff barriers.
Tyler, thank you. Tyler Kendall down in Washington. Much more from Tyler later on this morning. Joining us now to extend the conversation, Browne Gardner of Stifel. Browne, welcome to the programme, sir, and good morning to you. America has demands. Is it clear to American trade partners what those demands are?
No, I don't think so. I mean, I guess it depends on the country, Jonathan, and good morning. I think a lot of the demands is trying to isolate China, but each individual country has its own trading relationship with China. And so I think that's actually one of the confounding things about the whole Trump strategy has been that it was us against everybody else instead of picking off China and getting certain deals in place ahead of time to make it easier to isolate China in a broader policy agenda.
Browne, these are the 90-day reciprocal tariffs in terms of this pause that the administration is trying to get a deal done before those 90 days are up. But what about the sectoral tariffs? When are those going to be announced?
Great question. Trump, the president, signaled that more tariffs were coming, pharmaceuticals. He signaled that in early April. He said it was coming soon. I would think over the next couple of weeks, but I don't have a specific date in mind. But they are coming. I mean, one thing I think investors should keep in mind is anytime President Trump has said he's going to do something, he follows through on it. So if he says that tariffs on pharmaceuticals are coming soon, they're coming soon.
He also said, if we can turn to the Fed, that he cannot wait for the termination of Jay Powell. Browne, do you read this as he's waiting for the Fed chair's term to be up next year, or does he plan to oust Jay Powell?
I think he probably waits a year. I think the chaos and the undercutting of Fed credibility it would be so severe that it would damage the administration's longer-term goals by ousting him early. And that's credibility with investors that they'll never get back. Look, I get the president's frustration. The sense of frustration that he that he explains in public, but I think he will wait. There's really nothing to be gained by prematurely trying to get out the Fed chairman.
Brian, how much damage is being done just by the suggestion? It seems like there are a number of sacred cows in markets, and Fed independence is one of them. And when you start questioning that sacred cow and maybe putting it up on the chopping block, suddenly people get really nervous fundamentally about policy uncertainty in the United States. Has that already been accomplished?
You know, Lisa, I was listening to your previous segment with Brian Levitt, and there was a lot of conversation about uncertainty versus certainty. And I would argue that we actually have a more of a degree of clarity than we thought at the beginning of the year. Linking this to the tariff agenda, it is clear, Jonathan alluded to this, that there is clearly a move to restructure the entire U.S. economy and U.S. politics, the way we look at policy. So, I think that investors in totality are coming to the conclusion that this administration is moving in very, very different ways. And, you know, specifically on your point on the Fed, you know, once you start opening the Pandora's box and you start talking about the possibility of removing a Fed chairman, and let's be honest, this is not done in a vacuum, right? He's already fired a couple of board members from other commissions throughout the government. And the legal argument, the philosophical argument would be, well, if he can replace them, then he can replace the Fed chairman. I just think that the cost of doing so is so high that I think there are voices in the administration that can talk him out of it. But if it was left to his own devices, I think the chances are higher that Trump would fire Pyle than I kind of previously alluded to. I think he will ultimately be talked out from it, but I do think it's certainly something that he considers.
Brian, there's a lot to unpack there. You talk about how we do have some certainty about what John was talking about, which is rearranging the whole structure of the global trade order and how the U.S. is viewed in international trade structure, which has massive implications for the dollar, for Treasury yields, and for a host of other U.S. dollar-denominated assets. The lack of clarity here, I think, remains in how much of a check markets are. And I'm talking about both bonds and stocks at a time when some of the major CEOs from retailers are meeting with President Trump. Do you have a sense of how much this president is responsive to turmoil in markets and, frankly, a hit to the bottom line for a lot of these companies in the near term, which is inevitable if you restructure things in the way that we're talking about?
So the pause tells us that there is some sense within the White House, within the Oval Office, that they have to that the administration has to pay attention to markets, and they will respond to markets. At the same time, this president is in a second term. He's not going to be running again, jokes aside, for a third term. A lot of this is about legacy, and we're dealing with issues that he has been talking about going back to the 1980s. So yes, markets are a check to a point, but I think he is, to use the cliche, he is playing the longer game. I think he is looking longer term at his legacy. And so when we're talking about these restructuring, there are people in the White House who see financial markets as throwing occasional temper tantrums that will subside, and the markets will get back to normal, and equity markets will recover, and the bond market as well. But I think they are playing a longer game when we think about all these policy changes.
Brian, I appreciate your take this morning. Thank you, sir. Brian Gardner there of Stifel. We can handle growth scares. We've done that a million times. This is not your average growth scare. This is not just a shock to the cycle. It's a shock to the system. And it's going to take a while to internalize that. And we've talked about that repeatedly on this program over the last month.
I was speaking to someone yesterday close to the Trump administration who said, you know, Annmarie, stocks go up, stocks go down. And they are thinking about this long-term realignment. He is playing what they would say a bigger, longer game. But what is interesting there are voices who are looking at the markets. Obviously, Scott Bessent. After Liberation Day, he came out and he said, no, I'm not part of the negotiations. I asked him about that recently, and he said, no, I meant I wasn't part of the tariff charts. There is a pushback, especially when it comes to the bond market.
Equities right now, equity futures positive by 0.9%, and just a little bit of stability in the bond market following yesterday's sell-off on the long bond. Up next, we'll catch up with Robert Sockin of Citi, cutting expectations for global growth. Live from New York, you're watching Bloomberg TV. Bouncing back this morning, equity futures up by 0.9%, down on the month through yesterday's close by around 8 percentage points. The worst month potentially going back to 2022. On the Nasdaq up by 0.9%. On the Russell up by 1 percentage point. 3 hours away from the opening bell. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. U.S. solar stocks off like a rocket this morning. First Solar, that's the one I picked, up 6.7%. The Trump administration putting as high as 3,500% tariffs on Southeast Asian nations on their solar exports after a year-long study that was first commissioned by the Biden administration saying that they were selling into the American market at a lower cost of production. So those tariffs go on. The U.S. solar manufacturers benefit. Amazon also rebounding this morning, but this could be due to the fact that it fell more than 3% yesterday and that tech in general fell back into a bear market, at least as judged by the Nasdaq 100. But still a story to keep your eye on. Wells Fargo analysts saying that AWS has been pulling back on their data center leases, something that might look similar to what Microsoft did in the warnings of Alibaba, of Joe Tsai over there. AWS VP, though global head of data center, says that it's more about the day in and day out flow of AWS, and it still has very high demand. Finally, wrapping things up with some sell-side action. Loop analysts upgraded Norwegian Cruise Lines. Those shares up 1.5%. Their target now implies a 50% increase from here. A fascinating reason why they say cruises are a recession play because they're about 30% cheaper than land vacation. So they say buy this if we are indeed heading towards an economic downturn. John.
I'd rather stay at home. Danny, thank you. Danny, thank you very much. More from Danny later on this morning. Less about cruises. On our radar this morning, President Trump ramping up pressure on Fed Chair Jay Powell, warning the economy may slow unless, quote, Mr. Too Late cuts interest rates. Trump adding that there is, quote, virtually no inflation, pointing to lower energy and food prices.
There are a couple of questions here. Number one, how feasible would it be for him to get rid of Jay Powell and then prevent the FOMC from electing him chair again as just a member of the Federal Reserve? So there's some technical questions. There's also the issue of the other Fed members that do have votes, that he could potentially have to fire all of them, but that might be a bit of a stretch even for him. And then there's this question, and this was raised by RBC, which I thought was fascinating. It gets rid of a good scapegoat. Mr. Too Late, you take him out of the equation. Who does President Trump blame for some of the market turmoil that we've seen?
Blake Gwynn also makes the point in this note about this idea of a scapegoat, and then you're left with potentially a new Fed chair that you put in place. You're not going to want to scapegoat that individual. They said keeping Powell around and continually pestering him on social media makes it much easier to muddy the waters. And also, Jonathan, pull the narrative away from tariffs, which is causing a tremendous amount of uncertainty for the business community.
And also, as people have said repeatedly, what about the rest of the committee? You fire the Fed chair. What do you think everyone else on the FOMC is going to do in response to that?
Right, which is the reason why, essentially, it might be a bridge too far to fire all of them, because even for him, that might seem a little bit like, a little excessive.
This is only one policy you need to keep an eye on. The other one, of course, is trade. The White House saying the US and India have made, quote, significant progress towards a trade deal. This coming after a new round of talks in New Delhi between the Vice President J.D. Vance and the Indian Prime Minister Narendra Modi.
So I think this is a really important trade discussion. We learned a lot from the readouts. One, the U.S., part of that White House readout, said that the sides have finalized a roadmap for a possible deal to reduce tariff burdens. So potentially, if you cannot strike a trade deal in the 90 days, potentially you'll be reprieved. India, in this case, 26% reciprocal tariff rate, now down to only 10. You'll maybe get that reprieve if that minimum, there is a roadmap that negotiators could then get to for the end. Second, so they're willing to get to the fall for this. Second, what I also thought was interesting is that we did learn that India is obviously going to be one of these key priorities. And Narendra Modi went to the White House back in February. So I think individuals who made a point to make the U.S. a priority immediately after Trump's inauguration are going to be first to come for a trade deal.
The rhetoric has calmed down recently, but some of the language around allies and trade partners has been pretty brutal over the past few months. Shout out to Peter Schiff of Academy, who's made the point repeatedly that the American brand could be damaged abroad. And I think that's going to come into focus a little bit later on as well, with Tesla offering their report on first quarter earnings after the closing bell. Concerns rising after the car maker released weaker than expected first quarter sales. And you've got this backlash against Elon Musk happening simultaneously, Lisa. All things to think about going into the closing bell and this earnings report later on this afternoon.
I wonder if this is the reason we haven't been hearing a lot about Doge or Elon Musk recently. Seriously, it's a time when you're hearing about Code Red from Dan Ives, about the potential for him to get back in his seat as the head of Tesla. To your point about the damage to the American brand, quarterly sales of Tesla have fallen 41% in France, 55% in Sweden, 55% in Denmark, 49% in the Netherlands. And now Tesla's coming out with this discounted mechanism of lending to try to sell Teslas over in China. They are in Operation Play Defense and try to double down at a time where they are delaying their release of their lower cost vehicle in the U.S. It is a key moment to see how much this brand, which has become emblematic of the Trump administration, backtracks and tries to create some distance.
Tesla this morning positive by about 0.7%. Earnings in focus. This from 3M just moments ago, seeing 2025 adjusted EPS tariff sensitivity of 20 cents per share to 40 cents per share. That's a new phrase for you. Tariff sensitivity.
I was about to say tariff sensitivity. Please define what tariff sensitivity is and how you calculate 20 cents a share to 40 cents a share. And you're talking about this within the range of a full year adjusted EPS expectation for continued operations of $7.60 to $7.90. It's actually not as big of a range as you've seen from some other places. So how do they quantify this? Are they putting a task force on it?
I think they probably are. I think it's fair to say we're in uncharted territory for earnings in corporate America at the moment. The President of the United States expressing optimism as the administration looks to strike new trade deals. Robert Sockin of Citi marking down growth expectations, writing, quote, "We see global growth falling from just under 3% last year to 2.1% in 2025, as our forecasts have been marked down for a broad group of economies, including the United States." Rob joins us now for more. Rob, good morning.
Good morning.
2.1%. That's global recession territory, isn't it?
It's starting to get into that territory. It would be a distinctly weak year, much weaker than we saw over the last few years when we grew just a bit below global trend, but still probably would skirt that definition of global recession. But that being said, I think the risks to the forecast are skewed strongly to the downside, especially because within that forecast, we still have China growing at a decent rate despite this trade war going on between the U.S. and China. And we don't have a U.S. recession in the forecast. We have low growth but no recession. If those two downside risks materialize, you could easily get into global recession territory.
Just sit on China for a beat. What's driving that growth?
Well, it's interesting. If you go back not too long ago, we were actually marking up growth in China. We were marking up growth in Europe. These narratives were getting more positive. In China, we were starting to see signs that private sector demand was picking up. You had the positive AI story that was developing and the investments around that. But this trade war has kind of reversed that narrative, and the headwinds are going to be substantial. We do see the government coming out with more stimulus to try and offset some of that, which is why that forecast is not even lower on the year. But, you know, it's going to be a big challenge if this trade war persists.
How much can there be a huge divergence between the rest of the world and the United States, where the rest of the world actually takes off and starts expanding at a faster rate, especially based on the fact that rates can keep going lower? You might get disinflationary forces in certain places, and you have the potential for stimulus at the same time that money is flowing into their economies and away from the United States. I mean, it's a pretty potentially rosy scenario for outside of the United States to diverge.
Yeah, absolutely. And if you look at the contours of our forecast, you get a lot of softness in the U.S. You get softness elsewhere, and it depends on how these tariff negotiations and tariff uncertainty evolves. But other parts of the world hold up relatively well. Outside of China, most of the EMs, we've been marking some of them down slowly, but most of them still have pretty solid growth forecasts. But I do think that the policy uncertainty and the tariffs that are emanating from the U.S. is going to weigh on a lot of economies. I mean, for Europe's a good example. We had 1% growth over the next 4 quarters prior to these tariff stresses. Now we have close to 0 growth or just above that. So I think for the rest of the world, it's going to be hard to grow or at a solid rate, given that these tariffs are still looming large and trade uncertainty is still looming large.
How much would you have to see to get more constructive on the global outlook, where suddenly a weaker dollar actually helps support U.S. companies? You end up with a little bit more in terms of certainty with trade deals. And suddenly all of this sort of negativity reverses course. The hard data has been solid and things are looking a little bit more like they were maybe 3 months ago.
Yeah, absolutely. And I think we're in that 90-day pause. And if we start to get trade deals materializing over that period, and there starts to be signs that the administration is backing off of its tougher stance on tariffs, not backing off entirely. We do think those trade deals are going to have probably a 10% minimum tariff. Those sectoral tariffs will stay in place. But if you start to see us moving away from that very high level of uncertainty, where we don't know what the tariff's going to look like in a week or 2 weeks, and you start to get those deals emerging, I think the global economy is still going to have a tough patch for the next few quarters. But, you know, I could see that forecast for the global economy that's at 2.1 moving up a bit if that uncertainty starts coming off the boil. But right now, I think the risks, again, are still skewed to the downside, especially because more tariffs are probably likely to be announced in coming weeks, and we don't know how these negotiations are going to go.
And these negotiations are for trading partners, not China, where America gets most of its goods. How long can you wait around and not have a trade deal with China?
Yeah, and I think that's the challenging situation, is that this trade war feels untenable from both sides. You're looking at tariffs on many goods that go across both borders of well over 100%. That trade is going to be uneconomical. So if you keep those tariffs on, trade in those categories is basically going to fall to zero over time. And we still get, in a direct sense, that's not even including indirect trade through other countries, over 13% of our imports from China. So it's a big headwind. I think we're probably going to see the temperature cool down there as well. But the longer that persists, the deeper the risks are. Especially one risk in that conversation is what happens with global supply chains. Like, are we going to get shortages and stresses like we saw during the pandemic, given that China is still deeply entwined in global supply chains?
Can China still grow if other countries put their walls up?
Well, that's going to be another tough conversation, is if this trade war persists, are other countries going to put on tariffs on China to kind of gain favor with the U.S.? And we're going to have the world kind of breaking up into spheres. Again, I hope we don't go down that route. But China, I think, will be okay for the near term because they have enough policy stimulus space. They have a lot of connectivities with other economies. But if we're in a persistent deep trade war, it's going to weigh significantly on their economy over the medium term.
From the perspective of price stability, the Europeans might have to. Have you seen a chart of Euro CNY? Euro CNY has gone from 740 to 840 since the start of February. They're going to have to eat a lot of Chinese exports. Isn't that the biggest threat to price stability on the continent right now?
It's a big challenge because these exports have to go somewhere. And again, 13% of U.S. imports, that's a lot of goods. Some of that we think is going to be rerouted through other economies, as we were talking about, that eventually go to the U.S. But if the administration cracks down on that, that cuts off an important channel for those products. And a natural point for where those could go is Europe. But I think if that starts to happen, you again have a conversation, well, do the Europeans start to put on trade barriers of their own to kind of protect their own domestic industries? So this could get even messier really quick, which is saying a lot given how messy it's been over the last few weeks.
Just to sit on Europe, do you think they'll have to? That economy at the moment's at stall speed. I know a lot of people are excited about the prospect of fiscal stimulus, but we were already talking about 0% growth on the continent. What's this going to do to them? Disinflationary price action at the time where we have 0% growth on the continent.
Yeah, exactly. And that's the real challenge. And I think in the near term, they have other challenges to face as well, primarily also negotiating with the U.S. And I think that puts them in a very difficult spot, which is another reason that I think other countries are going to be putting pressure on the U.S. and on China to kind of come to the table and make some sort of deal. Because, as you said, this is going to be another challenge for Europe that is going to be difficult to handle. Actually, in an environment where, again, if you go back a few months ago, you were finally starting to get a positive narrative emerge out of Europe for the first time in several years. Unfortunately, that's largely gone away with the current trade stresses. That could come back if these trade stresses move away. But I think, again, at a minimum, they're going to be facing challenges from both sides, from the U.S. and China.
Huge changes in the past few months. Robert, it's good to see you. Thank you, sir. Robert Sockin there of Citi. Equity futures doing better, positive by around 1% on the S&P. With an update on stories elsewhere with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump's tariffs are starting to hit some Japanese firms. About 10% of more than 500 firms surveyed by the Ministry of Finance say levies have affected their business. CEO of Japanese beverage giant Suntory Holdings says tariffs could make companies reluctant to invest in the U.S. A Republican proposal to tax income of over $1 million at a 40% rate could generate about $400 billion over a decade. That, according to research at Yale University. The revenue could offset the cost of the party's tax package and fund new tax breaks like eliminating taxes on tips or increasing the child tax credit. And a check on Novo Nordisk shares falling more than 7.5% in the European trade. Strong data from Eli Lilly's rival obesity pill sparked fear that it will take market share from Ozempic. Novo filed for approval for a high-dose pill with the same active ingredients as Ozempic, but analysts expect Lilly's drug to have a better profile. And that's your brief, John.
Thank you, Danny. Thank you very much. More from Danny later on this hour. Up next on the program, U.S. exceptionalism at risk.
If this were a movie, we would say how to lose exceptionalism in less than 10 trading days, meaning that you have called into question these economic world orders. The end result is that we're all asking huge, major tectonic shift questions.
Up next on the programme, Krishna Guha of Evercore, live from New York City. You're watching Bloomberg TV. Live from New York City this morning. Good morning to you all. Equities recovering, up by 1% on the S&P. On the Nasdaq 100, up by 1 percentage point. Also, under surveillance this morning, US exceptionalism at risk.
If this were a movie, we would say how to lose exceptionalism in less than 10 trading days, meaning that you have called into question these economic world orders that have been so powerful for U.S. companies and being able to benefit from falling interest rates, from the ability to benefit from rising margins over time. And so the end result is that we're all asking huge, major tectonic shift questions.
So here's the latest this morning. Investors looking for safe havens outside of U.S. assets, with gold hitting fresh record highs. Krishna Guha of Evercore writing, we think any effort to remove Pyle would lead to a surge in stagflation trades, further curve steepening, dollar sharply lower, and a much larger increase in the risk premium on U.S. assets. I'm pleased to say that Krishna is back with us on the programme for more. Krishna, welcome back to the programme, sir, and good morning. You wrote about it going into the weekend last week. You said that if you love the trade off the back of the trade debacle, then you'll love the Fed independence trade, the loss of Fed independence. Can you talk to us about that, Krishna? Did we get a flavour for it in yesterday's session?
So I think we did get a little foretaste yesterday of what kind of a train wreck it would be in markets if the president ever decided to actually try to fire Fed Chair Powell. Now, to be very clear, I continue to think that it is not likely, it's not 50% or higher probability that Trump will actually try to terminate Powell. But it's clearly a non-trivial risk, a serious risk. And when it's put before markets, you get the verdict that you got yesterday. Yields higher, dollar lower, stocks lower, fundamentally reduced attractiveness of US assets across the board. And that is, I think, a cautionary message, and I hope it's being heard in the right places. Remember that up to this point, what we've seen in markets is a clear sign of erosion of confidence in US administration economic policy making, but we have not seen a loss of confidence in the Fed. We can prove that because up to this point, the inflation break-evens have stayed very well behaved. The market has not priced in stagflation trades. But if you ever got to the point where Fed independence was actually being broken, or there was an attempt to break it in real time, I think what you'd see is a shift towards stagflation trades, as well as a broader intensification of across-the-board market weakness in U.S. assets.
So, Krishna, let's talk about what we've seen so far. We have seen a rebalancing away from dollar-denominated assets. We've seen that over the last several weeks. How much toothpaste do you think is out of the tube? How much damage is done? How repairable is that damage?
Well, I think right now we're in an intermediate spot between business as usual ups and downs in markets and the kind of fundamental tectonic regime shift that one of your earlier guests was quoted discussing just before this segment began. What we've been seeing in the last few weeks is absolutely not business as usual, right? We've seen substantial upward pressure on real yields and the real term premium that investors demand to hold US government debt, despite a deteriorating economic outlook. We've also seen the dollar go down on days when the yields have been going up. That's the sort of thing that you normally see in emerging markets, and is a sign that capital is being reallocated out of the US at the margin. But I think it's still premature to talk about a fundamental regime shift. We're not there yet. The dollar was overvalued coming in on many measures. So some dollar retracement is not perhaps extraordinary. The world was over-allocated to the US. So again, reallocation out of the US at the margin, not in itself the sign that the old regime is breaking. But there are lots of warning signs here. And of course, the subtlety here is that if there is even a significant risk that we could be looking at an economic regime change, then that is going to affect asset prices today, well in advance of when we discover whether the regime is actually shifting or not.
Okay, so Krishna, let's game out what it would look like if, to use your phrase, we did see a real Liz Truss type moment in the United States with a real loss of confidence, both in Fed independence as well as policy certainty going forward in the United States. What would that look like in terms of asset prices going forward?
Well, so what I want to sort of point to here is, to begin with, that the starting position is very different, right? The US is not the UK. The US is the core holding in every global investor's portfolio. It's the core holding in every official sector portfolio, the dollar dominant currency. So it takes a lot more to generate the type of Liz Truss dynamics in the US than it did in the UK. And we're definitely not there yet. But what would that pathway look like, right? That pathway would essentially involve morphing from a tariff crisis to a fiscal crisis. And the mechanism by which that would happen is a global buyer's strike in the Treasury market at the time when the deficit blew out on an economic downturn, lack of serious fiscal consolidation in tax legislation, and potentially even some doubling down on unfunded tax cuts down the line to try to pull the US out of that recession. To be really clear, that's not my forecast. It's not even my main risk case. My main risk case is a garden variety recession. But it is more than a tail risk at this point already. And if the Fed chair were to be fired, I think the risk of that morphing from a tariff crisis to a fiscal crisis would move up a lot.
You keep saying we're not in a fundamental regime shift yet. We're not at this Liz Truss moment yet. So the catalyst for you might be something on the fiscal front. Well, what happens when the tax negotiations become the new main driver and the president is pushing for more than just TCJA?
So I think the area that we all need to be focused on and thinking about is the interaction between the trade policy, the tariffs more broadly, pulling back from international economic and security engagement on the part of the US, and the fiscal front, where the US is already running a large structural deficit. And as you point out, there's tax legislation moving through that looks at this stage unlikely to tackle serious fiscal consolidation, with pressures to add more tax cuts, to what is already in the hopper. So as every economist nerd will tell you, a trade deficit is simply a capital surplus. And so when you start to pull away from international economic engagement on the trade side, it almost inevitably is going to have consequences on the capital account side as well. And that's where we've got to be careful, because a good part of that capital is funding the US deficit.
Krishna, looking forward to continuing the conversation with you, sir. Brilliant, as always. Krishna Guha there of Evercore. Up next on the programme, we'll catch up with Steve Auth of Federated, Alex Nowrasteh of the Cato Institute, Lord John Browne of General Atlantic, and Mike Pyle of Blackrock. The second hour of Bloomberg Surveillance, up next.
If this were a movie, we would say how to lose exceptionalism in less than 10 trading days.
There's no way yet to gauge the impact of these policies. We'll see what happens, but it's not good.
We're going to have to see how this really translates into less demand for dollar assets.
The economy is on solid footing, but I think the question is, does that even matter with tariff levels this high?
We haven't had this before. This is an attempt to rewire the global economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Things shaping up in a more favourable way for those of you looking to take risk. Equity futures positive by 0.9% on the S&P, up by 1% on the Nasdaq 100. In the bond market, yields were higher by close to double digits across the curve at the long end yesterday. This morning, we're settling down just about unchanged on 10s and 30s. In yesterday's session, a big feature of what we witnessed, dollar weakness. This morning, just a touch of dollar strength. Euro dollar negative by 0.25%, 114.85, and a lot to look ahead to, including Tesla earnings after the closing bell. And this morning and throughout today, a ton of Fed speak. And the Fed speak, Lisa, gets more interested by the day.
Big question is, how much are you going to push back if President Trump tries to fire Jay Powell? How much are you going to try to essentially keep him in that position and hold on to your position? There is a real question here about how much this is real versus jawboning. And then there's an additional question, which is how much is just the jawboning alone doing enough damage to really undermine the confidence in ongoing policy in the United States? And that, I think, is a longer term question at a time where people still haven't decided or figured out just how much this market is a check on President Trump.
Well, Trump continues to double down, though. This started on Thursday when he talked about the termination of Fed Chair Jay Powell, and he reiterated yesterday how he was annoyed with Jay Powell and that he should be going for what the Trump says many are calling preemptive cuts. But I love what RBC came out and said this morning from Blake Gwynn, the fact that actually Powell in place is a convenient scapegoat if there is a downturn in the economy and there is consumer and business frustration, which we see in survey data and CEO calls when it comes to tariffs and their inability to plan.
To your point, I think yesterday some people got the sense that the president was looking for a fall guy, and that fall guy was Chairman Powell.
Which is the reason why some people don't take it as seriously. Nonetheless, there is a real question about whether he will go through with it. The lack of predictability, I think, is causing some jitters right now. And frankly, or yippiness, I should say. The issue that I keep having is how much are we looking at a Brian Gardner view of the world, which is what you raised, which is a potential reordering of the trade sphere versus a negotiation with a check that ultimately will be the bond vigilantes that are, James Carville's soul when he dies.
And Mohammed said it just there, a rewiring of the global order. Look, we're used to uncertainty. That's a feature of markets. There's nothing new about that. Or risk. You're meant to manage risk. But we usually manage risk within the rules of the game. And we understand the rules of the game. We also understand how institutions will respond to certain factors, certain catalysts, certain things that happen. I think now we're rethinking the rules of the game. That's a different moment for market participants to be in. And I still sense the confusion from people coming on the program trying to figure that out.
Confusion also from the companies that are reporting earnings. You talk about Tesla, a fascinating sort of poster child for this, given the sort of dual role of Elon Musk and the company as an international player. We heard about the tariff premium or tariff uncertainty of about 20 cents when it comes to 3M. All of the companies are trying to understand how to game this out, and they can't either, which raises the question about long-term damage just based on the uncertainty that we keep getting.
The market is really thirsty for the rules of the road. And the issue you have right now, take it the Jay Powell question. Scott Bessent says that monetary policy is a jewel box that needs to be preserved. Meanwhile, Kevin Hassett, the NEC director, comes out and says, well, this is something that the president and his team is studying when it comes to whether or not he can legally get rid of Jay Powell. There are no rules, and depending on who you ask, you can lead down a different pathway.
Equity futures right now on the S&P positive by 0.9%. Some stability in the bond market for now. We'll see if that holds. Coming up this hour, we're catching up with Stephen Auth, the Federated, on navigating through the fog of trade uncertainty. Lord John Browne, the former BP boss, on the outlook for energy. And Mike Pyle of Blackrock on diversifying beyond US assets. We begin this hour with stocks bouncing back following Monday's sell-off. Steve Auth of Federated Hermes writing, we're sticking with our now moderate equity overweight, waiting for a sign that the fog of uncertainty hanging over the market is beginning to lift. Good news, we might be getting closer. Stephen joins us now for more. Stephen, good to see you, as always.
Likewise.
Last time we spoke to you, you said, strap yourself to the mast and get through the storm. I think we learnt on some Greek philosophy from way back in the day. What do you do if the captain is trying to sabotage the ship?
Yeah, I mean, at some point that during, I think the week of the 2nd, I had a piece I was writing that I then trashed, saying, oh my gosh, he ran us into a reef on purpose. Look, I got to believe, I get this existential risk stuff, but when you're in a storm, I think you try to look out a little bit further and say, okay, where is all this heading? And remember, it's not just President Trump. It's the markets. It's the U.S. consumer. It's the Chinese saver. There's a lot of cultural and economic structures here that will hold together. It's not going to all just come apart. And where are we going? I think at the margin, we're going to probably have a kind of national sales tax in the U.S., call it 10%. Some of that's going to get paid by somebody else. We're going to have, with our other trading partners, less tariffs, most likely. That's what we're negotiating too. But we're not going to end up with the U.S. in a trade surplus. That's not going to happen the way the U.S. economy is set up. So I see a distant future here where we've got some tax cuts coming through. We're working with a national sales tax that we can deal with. It's about 1% of GDP. Some of that's offset already by the lower inflation rates. The bond market should settle down. And so what we've done is we said, okay, let's hold on to our modest equity overweight. Let's not get too out over our skis here. There's certainly the existential risk camp. And when he does stuff like, yell at Pyle, maybe to make an excuse for how things are going, someone has probably explained to the president by now that there's 14 members of the FOMC, and getting rid of Powell is not going to change a darn thing. So in the end of the day, that's just, I think, bluster. And so we just sort of work through it, and we look for these 5 milestones. And each milestone that hits, I'm going to get incrementally more bullish. We have some dry powder to add here, and we're leaning into value stocks. Another big advantage that no one talks about this market is everyone says we came into the market overvalued. That's not really true. We came to the market with the Mag 7 overvalued. But there's a lot of stocks in the U.S. market that are trading at 9, 10 times earnings, nice dividend yields, very defensive, and they're holding up reasonably well in this market. And certainly all of Europe was on sale entering into this. The euro was on sale. The dollar was overvalued. So a lot of these things are correcting, but the market has some strengths here. And the banking system, by the way, I would add, is in very good shape. And that's why the credit markets haven't started to come apart.
A ton to unpack there. There was one phrase you used. The bond market should settle down. What's the strategic anchor that underpins that view? Where does that confidence come from?
It's just partly because the president will react if it doesn't. One of their key objectives is to get the 10-year yield down. They know that that's key to getting the mortgage market restarted and the housing market. And we saw what their pain point is on April 9th. The bond yield went to 4.5. Boom. Besant's in charge. Navarro's off stage right. And, we're into negotiating these tariff deals. And he kind of clarified, okay, really 10% is where I'm heading.
How easy is it to discern some of the noise that we're seeing around policy uncertainty from some of the cyclical changes that we're seeing that are undermining some of the pillars of U.S. equity performance? You mentioned Mag 7. Overnight, Amazon reportedly paused some data center leases, which just builds on this fear that maybe we got ahead of our skis with the AI adoption story. Yeah. How easy is it to parse out policy uncertainty, existential risks from risk shift in terms of the business cycle in big tech?
It's not easy, Lisa. Of course not. That's what, a little humility in this business goes a long way. One of my expressions at Federated Hermes has always been humility at the highs, confidence at the lows. No one has all the answers to this market. That's why you sort of navigate you through. You never go all in. And, I don't think it's easy. I think it's particularly difficult now. But in moments like that, when what has paid off for me, is to look out a little bit more distant. Because when you get lost in the fog like we are right now, you can overly focus on every incoming. In the end of the day, the system will adjust backwards. And we started out reasonably strong. I mean, thank goodness. I mean, what if the banking system was stretched and capital ratios were low? Then we could really get into some existential risk issues.
You talk about barbelling it in a way, or that's sort of my inference from what you said.
Absolutely.
That there's
We're
this
barbelled.
sense. So you're barbelled. Is the barbell with cash and not necessarily treasuries? Because even though you do believe that fundamentally there will be a settling down, you don't want to depend on it, at least in the near term.
Lisa, if you ever need another job, give me a call. That's exactly how we're barbelled.
All right.
We're overweight cash and we're underweight bonds. Our idea is you're making 4.5% in the money market funds. Tom Keene's famous triple levered money market fund, which is finally working out for him.
Good place to be.
Yeah. And that's kind of why be in the 10-year bond. And, so to us, have the cash at the side and use it to incrementally make adds to equities. We added at 5,400. We got 5,000 as our next target. 4,500 could be after that. I don't know where this market's going to bottom out. I don't think anyone does. But I think longer term, I can see a path to 6,000 pretty easily. I mean, we're going to get back to $300 in earnings.
You keep talking about longer term. You talk about it's often darkest before the dawn. Is that end longer term, looking through the fog, the entire Trump policy? How much are you betting on making sure there is deregulation in this economy and that TCJA gets extended?
Yeah, I absolutely. As an example, Annmarie, I mean, the SLR rule, right, which has been, Jamie Dimon talked about that last week. That's been holding back the banks as a buyer of treasuries. That's an obvious. I think we're going to see that very shortly, right? And that'll free up bank capital, help offset the decline that Krishna talked about. There's going to be a decline in foreign balances of U.S. treasuries if you really do cut into, at least I would say what he's trying to do is cut into the growth of the U.S. trade deficit. Remember, we were on an unsustainable path. This thing was just going inevitably higher. So he's trying to slow the growth, maybe pull it back some. That's going to put down some demand for U.S. treasuries. You replace that with the SLR thing. So I think the chaos somewhat increases, and that's why it's on our list of milestones. A deregulation should start to pick up pace. That's a lever they can pull to help markets. The tax cut bill is going to have to pick up pace. That's another layer they can prove. And yeah, they're going to have to stabilize the treasury market or nothing else is going to work.
I've been through quite a few growth scares with you over the years. You've been long, strong and right for quite a while, so I'll give you credit for that. Just a final question.
Thank you, Jonathan.
What's the tell? How will you know if you're wrong this time and you need to change your mind? What are you looking for? What's the tell?
I'll be asking Lisa for a job.
The other way around.
Yeah, look, I would say if the 10-year goes a lot higher than 5, I think 5 is reachable for sure. And I would expect some real policy reaction at that level. If we sail through that, that would be a sign, gee, we have a bigger problem here than we realized. But the banking system would also have to come apart. I mean, one of the first people to speak at our Monday morning meetings these days is my credit guys. Because they're watching the credit markets. And okay, they did, credit spreads started to open up some relative to where they've been the last 3 or 4 years. But they're nowhere near.
But is that really the benchmark, the threshold to get bearish on stocks, that the banking sector needs to come apart?
Yeah, because what you're talking about is existential risk and the whole economy collapsing.
No, not necessarily. I'm trying to work out what would make you bearish on equities. And I don't think it needs to be the existential risk manifesting. It can be something else.
Yeah, it's hard to get me long-term bearish on equities because if you own equities, and this is sort of Warren Buffett view of the world, you own a set of very strong companies, some of the best in the world, that inevitably grow their revenues and earnings over time. You're not just owning a kind of ticket at Las Vegas here. You own a share in the global economy. And as long as it keeps marching along, some of the greatest companies in that economy are here in the U.S.
Yeah.
They keep marching along, and the earnings inevitably go higher, and the value of those companies goes up. It's not voodoo why stocks go up over time.
It's felt like a casino over the last month, that's for sure. Steve,
yeah, it's felt like a casino.
Steve, thanks
for
dropping by.
Take a couple of value.
Stephen Auth, Federated, Hermes. Steve, thank you. Just a programming note. At the end of this hour, Lisa is going away for an interview a little bit later. She's not getting a job with Steve, all right?
And I'm not taking a cup of Valium either.
Don't try that again, Steve. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Verizon shares trading more than 3.5% lower in the pre-market. It reported a loss of more phone and internet customers than expected. Verizon topped estimates on operating revenue and adjusted EPS, but saw a 15% loss in Fios internet subscribers from last year. It also reaffirmed its full-year guidance, but excluding the impact of tariffs. U.S. VP J.D. Vance spoke in India earlier this morning after meeting with Prime Minister Narendra Modi. Vance said that the U.S. wants India to drop non-tariff barriers and looks forward to stronger ties with the country. Previously, the U.S. reported that it made significant progress towards a bilateral trade deal following talks. Harvard University is suing the Trump administration for freezing billions of dollars of federal funding. Harvard's president said the freeze happened after it refused to follow illegal demands to make changes to governance, discipline, and hiring policies, as well as diversity programs. Trump has accused Harvard of failing to combat anti-Semitism on campus. And that's your brief, John.
Danny, thank you. More from Danny later on this hour. Up next on the program, the president still bullish on the U.S.
The economy is very good. We don't have inflation. I think we're doing really well. We're all set. There's a little transition, and that's going to happen. But ultimately, we're going to be the strongest that we've ever been.
Up next on the program, Nowrasteh of the Cato Institute, live from New York. This is Bloomberg. Equities firmer this morning, up by 0.8% on the S&P, likewise on the Nasdaq 100. Under surveillance this morning, the president still bullish on the U.S.
We're going to ultimately have a deal with anyone. The economy is very good. We don't have inflation. Energy's down at the lowest it's been in years. We hit actually $1.98 recently in a couple of states. I think we're doing really well. We're all set. There's a little transition, and that's going to happen. But ultimately, we're going to be the strongest that we've ever been.
So here's the latest this morning. President Trump remaining optimistic on trade negotiations after warning the U.S. economy may slow if the Fed chair does not cut interest rates in his latest criticism of Chairman Pyle. Joining us now, Bloomberg's Tyler Kendall, live from Washington. Tyler, we've heard a few times, on a number of occasions over the past few days, that things are progressing with the likes of Japan and India. But we've had no real details on why people think things are progressing. Can you point to any?
Hey, John. Well, President Trump himself says that there is progress when it comes to these negotiations, but that he needs a little bit more time. And it does appear that those countries that the U.S. said it was prioritizing are the ones that we are talking the most about when it comes to any progress. And Vice President J.D. Vance actually made a few headlines last hour speaking in India after the White House put out a readout saying that significant progress was made, including a finalized roadmap that could potentially lead to a deal. J.D. Vance, though, doubling down on the idea that the U.S. really does need to see non-tariff barriers included in any such agreement. We know India, of course, had moved to slash much of its tariff regime ahead of April 2nd, has also pledged to cut import taxes, for example. But this White House would really like to see some firmer commitments when it comes to boosting U.S. imports, particularly LNG, as well as high-tech defense equipment. And I'd say that India, of course, is one of those countries that the U.S. has largely seen as a way to shore up relationships and a bid to counter China. And another ally in the region, Japan, as you mentioned, also getting priority in these talks here. It was confirmed that Treasury Secretary Scott Bessent will be meeting with his Japanese counterpart here in Washington, the latter of which confirmed that they will be talking about foreign exchange rates. That was considered to be some positive momentum because it was our understanding that Japan was not interested in talking about currency during these talks. And so, John, really still a lot of uncertainty here, particularly about the timeline, particularly about exactly what the White House needs to see in order to clinch a deal. But I'd also just quickly add that we're watching not just the countries trying to engage with this White House, but also the private sector. Bloomberg News was the one yesterday to break that story that some major retailers visited the White House, including Home Depot, Lowe's, and Target.
Tyler Kendall with the latest down in Washington. Tyler, thank you. So on the one hand, we've got trade uncertainty. On the other, we've got threats to central bank independence. Joining us now to discuss, Nowrasteh of the Cato Institute. Alex, welcome to the program. This is what you had to say on the Fed. If they were controlled by the president, rates would fall, inflation would spiral, growth would stagnate, a disaster. Ultimately, that seems unlikely, but we should all be vigilant to that possibility. Alex, why do you think it remains somewhat unlikely?
Remains somewhat unlikely because the law is fairly clear on this. The ability of the president to remove and replace the chair of the Federal Reserve at whim seems to be outside of his power. This hasn't been tested, of course, in the last 112 years of the Federal Reserve system existing, but it seems fairly robust. Alex, so, you know, this president surprises us all the time, right? But I think the law is probably on our side here.
So when it comes to ousting Jay Powell, though, do you think the president is doing this to actually have a scapegoat if his tariff negotiations don't go as planned?
I think there's no downside for President Trump politically for challenging Chairman Powell. If he doesn't get what he wants, he doesn't get a new Fed chair, then he can always blame it on him. If he does get what he wants, then he has control over the central bank of the United States, which can help him politically. So there's really no downside. Of course, the major downside is on the U.S. economy if he succeeds. If he succeeds in getting power with the central bank, ending central bank independence in the United States, then you'll have those negative economic consequences that I talked about: higher inflation, lower growth, more political and economic uncertainty. But if he doesn't get control of the Fed, but he just threatens it, then there's a chance that either Powell or future chairman of the Federal Reserve will listen more to the threats of politicians like they did in the 1970s when we had stagflation, and then we'll have just poor economic outcomes going forward.
Alex, where is Congress in all of this, both when it comes to tariff and trying to wrangle back some of the control on tariff policy, and also when it comes to Fed policy? Jay Powell does have a boss. It's Congress.
So I have been asking where Congress is for basically my entire career on almost every issue. I mean, the long-term trend for Congress is to pull back its power and to grant more and more power to the president. So Congress is not like a dead institution. It's not a dying institution. They make noises sometimes. They introduce legislation to try to rein in the president. There was recently a resolution introduced by Senator Pyle to reduce the president's power to set tariff rates. There are numerous challenges in the courts saying that no, Congress has this power, but ultimately it's very difficult to make Congress exercise its power if it simply doesn't want to. And what we are seeing right now is a Congress not taking up its powers or responsibilities to either rein in the president or to govern. They are focusing importantly on the tax cuts bill. They're focusing importantly on the Tax Cuts and Jobs Act, extending that. But outside of that, they are not considering major pieces of legislation or getting a wrangle or reins on this president.
Will that change? Will they become more vocal as we head into the midterm elections?
They probably will. Now, for Republicans who control, the House, of course, being more vocal is dangerous because the head of their party, of course, is President Trump, and he is in charge. And sort of the cause of a lot of this economic uncertainty is his arbitrary wielding of power. So they face a dangerous trade-off there. But moderate Republicans, I think, will definitely start to step up and try to distance themselves from the president if the economy gets worse and it looks like a terrible midterm election for them. Democrats, of course, will always be out there criticizing President Trump, no matter how good things are or how bad things are. But they will probably be louder if things get worse. But they might be louder in the sense of if the Republicans saying, well, this means that President Trump means more power. So that doesn't necessarily bode well if they start to be louder.
What a moment. Alex, thank you, sir. Alex Nowrasteh of the Cato Institute. Equity futures right now in the S&P doing better. If you are just joining us, welcome to the programme. Equity futures up by 0.8% in the bond market. A sell-off yesterday at the long end of the curve this morning. Yields just a touch lower, down by 2 basis points on 30s. Similar move on a 10-year, down a single basis point. And in foreign exchange, just a ton of dollar weakness. The dollar heading towards one of the worst months we've seen over the last decade. Euro dollar at the moment negative by about 0.2% to 114.84. So the dollar making just a little bit of a comeback as well. Up next on the programme, we'll talk energy. We'll catch up with Lord John Browne of General Atlantic from New York City. You're watching Bloomberg TV. Equity futures on the S&P doing better, positive by 0.8% on the S&P 500. On the Nasdaq 100 up by 0.85 with 2 hours until the cash open. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. We have some earnings to get through, and you'll be hard-pressed to find companies that aren't talking about Washington in their earnings. Verizon shares down nearly 4.33%. They had a larger loss on subscribers for their internet and mobile phones than they had expected. Now, part of this is about competition, but I should say their competitor shares are also falling this morning. The other, maybe more interesting part is that federal spending on these phone plans has been pulling back significantly significantly for them, as we've seen the Doge cuts in both costs and jobs. So those shares down this morning. Kimberly-Clark also reporting, and they are lowering their expectations for the year. Those shares down more than 3%. The CEO saying that their assumptions for costs are going to be higher than they had assumed at the start of the year because of tariffs. Now, it does imply that they're going to be eating some of the margin, and hence you get the reaction in the share price this morning. Again, down 3.2%. Finally, wrapping things up with GE Aerospace. They've actually maintained their outlook for the year, and that includes the tariff outlook. So those shares up 2.6%. They said that their forecast assumes that there's no tariff escalation and no recession. Would be interesting to know what exact numbers that they are using for their calculations, given we don't have the final numbers on things like reciprocal tariffs yet, and that a lot of their customers on various airlines have reported some potential issues to come. John.
The clock is ticking on negotiations on the trade side, that's for sure. Danny, thank you. More from Danny later this hour. On our radar this morning, President Trump continuing his attacks on Fed Chair Jay Powell. Trump saying there can be a slowing of the economy unless Powell, a major loser, lowers interest rates.
So he's doubling down on his jawboning of Fed Chair Jay Powell. The issue is, of course, does this stop at just jawboning him to try to lower interest rates and really, as RBC calls it, using him as a scapegoat? Or does he actually try to meet with advisors, as Kevin Hassett said, and really think about ways they could get rid of the Fed chair? And if that were to happen, the pushback on the markets would, I think, be brutal based off what we saw yesterday.
I'd just like to state that that was a direct quote, not my words. Powell, a major loser.
Yeah, well, to me, I'm just wondering, let's say they cut rates to zero. Let's say that they do. If they're targeting the 10-year, what happens to the 10-year? Is that a positive thing? At this point, the market is saying, if you get what you want, well, you're not going to get what you want. So this is going to be a very interesting moment about who gets the ear of the president and whether this is a reflection or whether this is just scapegoating Mr. Too Late. You know, it's his fault.
Do you know what I hear consistently from the bulls on Wall Street? They believe the policies are so extreme, they're self-limiting. You hear that repeatedly. They believe that in the bond market, you'll get the constraints. Yields will push back. They'll have to back down. Same with trade, the equity market. I hear that repeatedly.
You know, I'm actually sympathetic to some degree, because if you take a look at the polls in terms of the favorability of the president, they do suggest a check in terms of the midterm elections. You are getting lawsuits when it comes to certain places where people believe that the president has overextended his powers. So there is an institution that you can't completely interrupt by making vast proclamations.
I want to turn to this story, an update on what's happening with retailers. President Trump meeting with retailers Walmart, Home Depot, Lowe's and Target. The talks coming as businesses look to navigate higher tariffs. Spokespeople for the companies involved calling the meeting productive. I'm not sure they can say anything else at this point, can they?
Productive. Another word they used was constructive when I looked at all the readouts from some of these companies and how their White House meetings went. Obviously, I think was most interesting, Target, Walmart, more than half their goods coming from China. But Walmart specifically, they're now in the West Wing talking to the president. A few weeks ago, our reporting was that they were in China talking to these factories saying, please cut your prices because we're not going to be able to buy as much from you and we don't want to pass on as much to our consumers. And the Chinese ministry then, the Commerce Ministry, called Walmart executives in and said, please do not go to tell us what to do. They are trying to stand tough. So Walmart, all these companies are square in the middle, and you see them almost ping-ponging between Beijing and Washington.
The fact that these executives from Walmart, Home Depot, Lowe's, Target have an audience with the president is actually really important, because they're going to give the practical realities of their supply chain at a time where it's unclear exactly who's going to absorb the costs. It is interesting to hear Home Depot say that it works with administrations from both sides of the aisle, and other people coming out and just declining to comment. Exactly what was said, who knows? The audience itself, though, to me is notable.
I think the Target spokesperson said they want to focus on offering Americans value, which I translated as cheap goods from abroad that we want to carry on importing without big tariffs. Now, whether they get to do that or not, I think remains to be seen. And we're going to see in the next few months.
It's a good question. In other words, are you willing to torpedo a massive U.S. company to try to restructure trade? And is he going to tell that to their face? It's interesting about whether, again, in this audience, how direct some of these conversations were, given the fact that Walmart is going to invest in value, which means that they are going to basically absorb the losses in their balance sheet and profit margins in order to keep prices the same.
Let's talk about that word invest. How can you make investment decisions right now? CapEx decisions. Amazon is pausing some data center leases in a pullback for web services and AI. Analyst at Wells Fargo citing discussions with several industry sources saying this could be a natural ebb and flow of hyperscaler activity. Now, this is something we've seen and heard a few times now in the last few months.
Yeah, Microsoft doing something similar. A big question here, and if you take a step back, and this is what Steve Auth was talking about. How do you decipher what we're seeing with policy noise and the ebbs and the flows of maybe an AI supercycle that got maybe overpriced a little bit in the markets? That's an interesting kind of analysis that this just adds to. If you get Amazon pulling back, does this mean a wholesale retrenchment, or are we just seeing the luster lost from the AI promises and then a reinvestment later this year when everybody really needs it again?
What did the Treasury Secretary Scott Bessent say to Annmarie a few weeks ago? We got a Mag 7 problem, not a MAGA problem in the equity market. He was talking about DeepSeek and some of the revelations in this space over the last few months.
He was talking about the fact that that is why you saw issues like the tech companies that are not doing so well in the equity market. The issue is, of course, you see the S&P 500, the Dow, they're all suffering since Trump's inauguration. I think most investors would say it's not just a Mag 7 problem. It's a little bit of a MAGA problem as well.
They've got a bigger problem than that, that's for sure. We are bouncing back this morning. S&P 500 futures up by 0.8%. Let's talk about energy. The US imposing new levies of over 3,000% on solar imports from countries in Southeast Asia. The move delivering a win for domestic manufacturers while intensifying headwinds already threatening the country's renewable power development. Beyondnetzero co-founder Lord John Browne writing, the energy transition is no longer a rising tide lifting all boats. It is becoming a more complex, fragmented investment landscape and requires sharper focus and strategic capital allocation. Joining us now, the man himself, Lord John Browne. John, it's good to see you, sir.
Very good to be here.
How much harder is it to make plans for cross-border investment in a time like this one?
Well, the uncertainty is so high that the answer is very difficult indeed. So you're going to use what you have in inventory, see what you can buy locally, and keep going where the IR, the internal rate of return, is satisfactory and gives you clearance above your cost of capital. As always in business. So a lot of things will be changing. A lot of things will be changing in the United States. The world outside the US will carry on in a very different way.
Well, let's talk about the United States and the differences to the rest of the world. You know the supply chains far better than I do. Can you fully domesticate supply chains here in the United States to achieve the transition that people like you would like to achieve?
You could, but it will take an awfully long time. I mean, when you're setting up a factory to do something, getting all the raw materials in place, it doesn't happen overnight. This is way beyond an electoral cycle to get this done. So it just takes time. In the end, there has to be some way of getting what you can call a win-win situation, even though the philosophy here appears to be self-sufficient, to have manufacturing in this country, and to have everything under the control of the United States. That is a very difficult thing to achieve in almost anything to do with energy, with a single exception of natural resources that you own. And then you can do something with them.
It feels like we're stuck between two extremes at the moment. On the one hand, entirely dependent on things coming out of China, and on the other hand, bringing all these supply chains back to the United States. Is there something in between? Is there something we can do in between?
Well, there is, of course, brand new sets, different sources of energy. So have a revival of nuclear, for example. Create lower cost nuclear if you can get there. In fact, use more natural gas, which is what I think the big theme of today is. If you can find enough turbines to power up to make electricity. And there the supply chain, again, is very, very tight. Being enhanced in the US at the moment, but again, that takes time. So turbines are sold out until probably the end of 2028. So again, long term, energy doesn't move on a dime. It moves very slowly because it's very high capex and requires very complex supply chains.
There's a question then about how much President Trump's policies can derail some of the renewable energy investments that we've seen around the world. In particular, your former company, BP, which has made a real big point of transitioning. Has that been undermined in some capacity with some of the moves away from those policies by the Trump administration?
I think day to day, yes. But when you look at the world outside the United States, it's very clear there's a lot of momentum behind reducing greenhouse gases. And you see it every day. You know, Japan's just announced it's taking to the diet a new idea on carbon credits and carbon trading. The World Shipping Organization is going to try and reduce emissions from ships. And a lot of people are still investing. But they'll invest at maybe a slightly different pace than they were doing previously, but they're not losing the big purpose. In the end, you know, the politics do not control climate change itself. and people want to control it. So, but the actors all change. I think the case of oil and gas companies is what you might call a very specific case. You know, in the end, oil and gas companies have to be at their heart oil and gas companies. They're very, very good at that. They find oil, they find gas, they produce it, take it to the market. And if they let that business go, then investors worry about what else they're going to do, because their skill base in doing renewable energy, all the other things, is not as strong as the oil and gas. They can do one thing, or two things. One is they can reduce methane emissions, which they continue to do, and secondly, develop new ways of doing carbon capture and storage using old oil fields and gas fields.
Political players change, and some of the rules of the game can change, but geopolitics doesn't change as much or as quickly. And I wonder how much this shift toward renewables outside of the U.S., let alone in the U.S., is dependent on materials and goods from China, which has centered itself as the main producer of solar panels, of so many of the renewable resources, and has a lot of the precious metals that go into all of these things. How easy is it to remove China from the shift toward renewables around the world?
It will be very, very difficult. But it's not the only place in the world with rare earths. It's not the only place in the world where you could, in theory, make silicon wafers to make solar panels. It just takes time. So, like everything, I mean, business seeks the lowest cost solution and the most stable solution at any time in its life. So it will continue to do that until such a time as it's not possible. In that case, we get derailed. But we have to think very carefully about supply chains. You know, one example, for example, is something which goes into certain types of nuclear reactors, highly enriched uranium. It turns out that about the only place in the world we could get that is Russia. And we were dependent on that. So that supply chain has to change. So all of this, I think, in a new geopolitics of different relationships, makes people begin to think what can happen. And there will be a check and balance. In the end, when things are impossible, the possible is found somehow. You know, that's what happens when it comes to business.
When it comes to China, though, how do you think officials should be viewing climate priorities versus national security priorities?
Well, it's a very good question that not everything is to do with national security. Obviously, people could argue that simply giving people $1 improves their bellicose nature. But that's not actually true. And provided that one is very careful about what is the relationship based on, whether it's secure things, not secure things, then I think you can carry on. In the end, of course, great powers have to keep to themselves the very central core of the castle, which is very important technologies of the future. And that, I think, will actually define the very nature of great powers. And so there is a lot of concern about that. I think making solar panels is not one of those issues.
John, appreciate your time, as always, sir. Much needed clarity on an important issue. Lord John Browne there on the energy sector. Thank you, sir. Appreciate it. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Pope Francis' funeral has been set for this Saturday at 2 p.m. Eastern Time in St. Peter's Square. Plans to choose his successor are underway. The College of Cardinals will meet in conclave in about 2 weeks, with about 135 cardinals voting. The U.S. could produce one of the contenders, Cardinal Raymond Leo Burke, an arch social conservative. 3M shares are racing earlier losses to trade higher by more than 4% in the pre-market trade. It reported earnings that beat analyst estimates. It also stood by its full-year guidance, but said it could see a tariff impact of 20 to 40 cents per share. Elsewhere, Bitcoin is also touching its highest level since early March. The digital currency has rallied almost 20% from its April 7th low after President Trump's tariff announcement. Bitcoin is now trading more like gold and has recently decoupled from U.S. tech stocks. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on. Up next on the programme, upending the status quo.
You can suddenly have all sorts of other things questioned about the Fed if it's in direct conflict with the White House.
It is a bad scenario for the U.S. economy.
That all moves in the direction of slower growth, higher inflation.
Up next on the programme, we'll catch up with Mike Pyle of Blackrock from New York City. This is Bloomberg. The market doing better this morning so far. Equity futures positive across the board on the S&P 500, up by 0.8%. On the Nasdaq, a similar move. In the bond market, settling down, yields lower by 2 basis points on 30s, down a single basis point on a 10-year. Under surveillance this morning, upending the status quo.
You can suddenly have all sorts of other things questioned about the Fed if it's in direct conflict with the White House.
This just adds to another one of those walls of worry.
Trump is trying to pass the buck to Pyle for whatever market problems exist.
We think it is a bad scenario for the U.S. economy.
Concerns about political independence of the Fed, that all moves in the direction of slower growth, higher inflation.
So here's the latest this morning. Tariff uncertainty and threats to the Fed's independence, upending investor confidence and drawing capital away from U.S. assets. Mike Pyle of Blackrock writing, this is a moment where strategies that are more market neutral or factor neutral can shine. Strategies that are less dependent on the overall direction of markets to generate returns. Mike joins us now for more. Mike, good morning. Good to see you.
Good to be here.
Feels like a massive change is underway, and we've talked about this repeatedly on this programme, that maybe it's a shock not just to the cycle but to the system and how we think about investing. How are you and the team thinking about those issues at the moment?
Yeah, I mean, I think your framing on that has been spot on. And I think one of the things that's really important to disentangle, and we don't have enough evidence to really come to judgments around, is clearly we've seen an unwind in sentiment around U.S. exceptionalism since the start of the year. I mean, that sentiment was probably at a pretty extended place coming into 2025. But I think there's a difference between an unwind in sentiment and something that's more structural and long-lasting over a multi-year period. And I think I would just highlight, yes, there have been dents in that thesis over the course of the year, but there are still really important strengths in the U.S. model. You think about the quality of our corporate sector and the type of innovation and dynamism it brings. You think about, and I thought about this a lot when I was in government, just how durable the dollar is as a cornerstone of the global economy. These aren't things that play out over months, and I think that's why it's important to try to disentangle exactly your point, like what if this is just an unwind in sentiment and what can be genuinely more long-lasting.
What would be on your dashboard to help you navigate that? What would be the tell for you?
Yeah, I mean, I think that two of the things that we're keeping a close eye on as we think about the U.S. cycle economically. And I think that, U.S. economic strength as we play this forward over the next couple of years is going to be an important component of that is, yes, this has been a significant shock and is going to be, on growth, on inflation. But how big of a shock and how persistent, I think, is an ongoing question. Again, two places we're going to be looking at. One, the U.S. consumer. How does the U.S. consumer hold up? I think the data right now is pretty uncertain. On one hand, I think we do see behavior on the good side that's suggestive that consumers are pulling forward a lot of demand to front run the tariffs, and we might see a significant fall off on the other side. On the flip side, you see U.S. consumers stepping into places like restaurant spending, like eating out, which is suggestive both of holding up and a shift of consumer behavior from goods to services. That's the kind of question that I think is going to say, is the U.S. consumer still the consumer of last resort globally? Is it still going to hold up? And that's going to be a big part of that structural picture as we roll the clock forward.
Another big part of that structural picture isn't just the companies and the strength of them. It's the strength of the U.S. debt market and how much you can have reliance on this idea that it is a stable, deep, liquid market when you've seen trades that resemble something of a penny stock. And I do wonder how much you can get excited about a 30-year Treasury with a yield almost at 5%. Or do you say this is no-go until we get more clarity on that story?
So I'd sort of say a couple of things. I mean, one, I think that you actually highlighted overnight, Lisa, on Twitter, an interesting evolution in who's buying Treasury securities, and that move away from foreign buyers to U.S. buyers suggests, this isn't just a thesis about foreign investors reconsidering U.S. assets. It's a question about, the overall attractiveness of Treasury securities. And I think there, I just look to the basic, bread and butter. What is the sort of forward path of U.S. growth? What does the U.S. fiscal picture look like out over the medium to long term? I think on that question, we're going to get more certainty as we move into the summer and fall about what that trajectory looks like and how much upward pressure we're going to end up seeing on term premia. I do think that our view at BlackRock is they're pressures on the Treasury rates are going to be higher, particularly when we see, uncertainties around fiscal and other dimensions. But I think, to your point, this isn't just about foreign investors reconsidering Treasuries. It's about really looking at that bread and butter from U.S. investors and foreign investors alike.
It has highlighted, though, the question around diversification and whether that looks very different. And you talk about not having a market correlated type of approach. Has the story of gold as being the sort of key diversifier gotten overplayed, and that sort of really being a more complicated story than just that?
Yeah, I mean, I'll be the first to say I'm not an expert when it comes to gold. I think one of the things I've sort of looked at myself and said, this has clearly been a good trade for diversification, but will it be going forward? And I think one of the things that asset allocators have consistently cautioned around gold is, this isn't a yielding asset, and it's one that has had a big run up already year to date and over a longer horizon. I think that's why, to our eyes, strategies that have held up well in this market environment, things like quant strategies, like I said, more market neutral, more factor neutral, have really held up quite well year to date. And I think what they offer is return, income, diversification, liquidity. These are the types of things that investors are looking at. And I think that's one of the reasons why we've been advising clients that those types of strategies, those liquid alternatives, those hedge fund strategies are an important part of getting return, liquidity, diversification in an uncertain moment.
You sound constructive, though, right now. What's your advice to individuals who look at every single truth and see the market whipsaw and is trading on that moment when you, working in government, know that a lot of this can take a very long time?
Yeah, I mean, I think that's one of the things that I've been thinking through. As you know, Annmarie spent a fair amount of time in the middle of the trade negotiations. And I think on one hand, I think there's a fair amount of constructiveness out there that the administration can reach deals, out of the gate, perhaps within India or Japan, that sets a template for what additional deals could look like. But the part of me that served in government is a little more cautious. These are hard negotiations. Tariff issues are hard. In some ways, non-tariff issues, behind the border issues are even harder. Oftentimes they go to really sensitive political issues in the relevant country. And so on one hand, want to see that template for what a trade deal, but on the other hand, I'm cautious on the timeline that can play out, because these are hard discussions and hard negotiations.
Are you happy you're not in Washington this week?
I am happy to be right here in New York City with the three of you.
We're happy to have you. Mike Pyle of Blackrock. Lisa will be heading off to Washington very shortly. Looking forward to your conversation a little bit later.
Yeah, we're going to be speaking with the IMF Managing Director, Kristalina Georgieva, and I love that. Mike Pyle comes in and he's like, I'm not there. It feels pretty good to be here, but I hear you guys are heading down and it's going to be a lot of fun. I'm actually looking forward to it. I think it'll be really interesting.
Looking forward to hearing from you and from the IMF Managing Director a little bit later on this afternoon. Annmarie will catch up with Lisa and me tomorrow morning. Looking forward to that. Coming up, Tom Kennedy of JPMorgan, Tom Narayan of RBC, former New York Fed President Bill Dudley and Michael Kushma of Morgan Stanley. The third hour of Bloomberg Surveillance is up next.
This is an attack on the independence of the Fed.
If there is a disruption to the Fed's independence, we are in a slippery slope.
One of the keys to the U.S. financial market is the independence of the Fed.
That's so obvious, the negative ramifications of this. But given the unpredictability we've seen in this president, anything's possible.
The end result is that we're all asking huge, major tectonic shift questions.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now. Your opening bell is 90 minutes away, and equity futures are doing okay. Positive by 0.7% on the S&P 500, bouncing back on the Nasdaq as well. The Nasdaq 100 up by 0.8. In the bond market, yields a little bit lower. This brings you some comfort, I'm sure. We're down a single basis point on the 10-year. We're down 2 on 30s. A lot of doubts about U.S. safe haven status all over again in yesterday's session.
All over again? Why? Because the president was doubling down yet again about how he's really angry, frustrated, unleashed yesterday once again on Jay Powell to lower interest rates. And everyone keeps coming back, Jonathan, to that Thursday post, when you and I are sitting here trying to make out what the president meant when he talked about termination, the end of Powell's term next year, actually trying to oust him. In the midst of the fog when it comes to tariffs, there's now this fog when it comes to the Fed. But today, there's a little bit of a reprieve.
It felt like he was looking for a fall guy yesterday. That one post where he talked about the possibility of the economy softening and then laying blame at the feet of the Federal Reserve Chairman, Jay Powell. Do you think there was an acknowledgement there, just implicitly, from the President of the United States that maybe we could be in for a soft patch in the not-too-distant future?
I think so, because he's looking for an individual, as RBC puts it, to scapegoat. And what better than the Fed chair, especially when you can try to politicize Jay Powell, talking about the fact that the Fed cut interest rates before the last election, saying that he was trying to juice the market for Joe Biden and then a la Kamala Harris. That is why this potentially is working. But Neil Dutta said yesterday in a fantastic post, saying this doesn't really make sense when they were talking about how the economy was doing well when they came into office. Now this doesn't really work, this flip-flop.
Yesterday, new lows for the US dollar. This morning, bouncing back. Euro dollar pulling back. Some euro weakness for you. 114.84 and that currency pair. Coming up this hour, we'll catch up with Tom Kennedy of JPMorgan as concerns over Fed independence weigh on US assets. Tom Narayan of RBC with Tesla earnings on deck. And the former New York Fed President Bill Dudley on the risk to Fed independence. We begin this hour with the dollar heading towards its worst month since 2009. Tom Kennedy of JPMorgan writing, the dollar as the world's preeminent reserve currency is under siege. The dollar is depreciating as the stock market declines. This likely has traders betting that global flows towards the US will slow. Tom joins us now for more. Tom, good morning.
Good morning.
Good to see you. What do you think of what's happening with the Federal Reserve and the erosion of the safe haven status of the United States?
Economists will traditionally say the independence of the Fed affords America a couple of luxuries, but preeminently a stable inflation outlook and confidence that you can lend to the U.S. government for a long period of time. I think we're seeing an erosion of that confidence happen right now. It also has bigger knock-on effects throughout the economy as well, as the dollar is not becoming that safe haven asset. For the last 15 years, we've seen global investors just pour into America. About 30% of global flows or global invested assets are in the U.S. So in America, we feel like we're having some pain. But global investors, as the dollar depreciates as well, feeling even more pain, assuming they're unhedged. So that safe haven status is under siege, as I'm saying there. But also now it's creating these other ripple effects about how we do portfolio construction. Stocks and bond diversification. Like, you can look at past clips of your show, guys. Everyone trying to find that inverse correlation coming back. It's been over 3 years now. Inverse correlation, not there. It's a new era for multi-asset investing.
Let's unpack some of that, particularly the last point, which is incredibly important. Before we get there, I want an understanding from you. That dollar long that we've built up over the last decade plus across several asset classes here in the United States, both equities and fixed income. Is this just a natural rebalancing of that, or is there something more nefarious going on here? Because that would take us to whether we really need to rethink about portfolio construction in the modern way we've viewed it over the last several decades.
Well, what's the pillar of a reserve currency? Is a deep liquid market we could all invest in? So that's really still there. Can we get in and out without moving the price? Yeah, I think that's still there. Confidence in the common law system as we know it? I don't think that's more confident today than what it was years ago. So there is some knock that's happening there. Your question is a great one. Is it a complete rewrite or is it an adjustment? I think it's got to be an adjustment in that this deep liquid pool of investing in America, there isn't anywhere else to really go with that. However, the market is voting with its capital where it thinks safe haven status is. There is no statistical model for gold now. It's not interest rate differentials. It's not driving gold at this point. And when you look under the hood of what's happening in gold, is it financial markets betting in the futures and options market? Not really. Volumes there are not at all-time highs, yet we know prices are. So it's real end-user investors finding a new diversifier. I think that's the game as we move forward. Marginally, what's the best diversifier? Is it gold? Might be. Could it be Bitcoin? Maybe. Could it be things like real estate and infrastructure? I'm betting it's going to be those as well.
The market's voting. You've clearly got a view. What do you think it will be in the years to come?
I think the best of the dollar exceptionalism is behind us as we move forward. And does that mean a complete rewrite? No. It just means we have to adjust the way we do portfolio diversification. And as we start to look to those things, you're seeing people adjust. The long end, I'm not as confident. You're pricing in more Fed cuts, but you're not seeing the long end come down. This is a real challenge for America and the willingness and ability to take down the deficit. It's a problem.
Who could fill the void, though, if the U.S. is no longer, or the U.S. dollar is no longer the global reserve currency?
Yeah, I think that's the balance that we have, Annmarie, is there is no obvious deep pool of liquid assets that we can get in and out of. So I don't know that there is one. But there have to be these adjustments on the margin because now global investors are seeing, wow, when things go bad, American assets, I'm feeling more pain than investors in America. They haven't experienced that for really 25 years. It's been a long time.
What happens if we do get a ton of trade deals in this 90-day reprieve, and then by the end of the year there's a grand bargain with China? Does everyone just come rushing back in?
To some degree, we'll see a reprieve. But what's the famous saying? For every inch forward, it can be a simple step back. But it's going to take a long time to rebuild that confidence. And the discussions about Fed independence are a big piece of that as well. So what happens in the Supreme Court and with the oustings there from the Trump administration will be very important to restore that last pillar of reservedness, which is common law system that we all agree on.
So let's focus on the basics. If you're running a current account deficit, you need two adjustments. It's either through the rate, yields have to go up, or the FX channel, the dollar has to weaken. Had a combination of both. You're leaning more on one than the other in the years to come?
So far, the currency has the most space to go. Even in your traditional interest rate models for the dollar was as overvalued as it's been since the 80s. So you have some pressure you can take out of that. But I think that mechanism in of itself, it's kind of silly to think that you can separate the currency depreciation from the capital flows. So it's going to be a combination of both. I think we're in the first phase, which is the currency, and then the global flows we'll see, and it'll come back to your point of how far do we push these tariffs?
This is clearly going to affect the premium that people want to pay for US assets.
Yeah.
How is that changing your view of the world domestically here in the United States, and particularly what you're working on now, real estate?
Yeah. It's creating this new diversification angle that you have to have. Since the sell-off here, cash and the Barclays Act have given you a similar total return performance. So it's not giving you the diversification, and it's not giving you the yield outperformance that you would have expected. So now you got to turn your portfolio construction into something else. Where can I find, if this goes very bad, a place where I can get some inflation protection? Infrastructure, real estate are places that will be there. And alongside higher rates, it's going to be very hard to build new supply. So now you're confining the supply picture for an asset where demand should go up. I think real estate, infrastructure are going to be critical pieces of the diversification angle for multi-asset investors globally.
What does trade policy mean for what you're working on right now when it comes to real estate?
Yeah, so the trade policy impact, just like everyone on Wall Street, what's our exposure? We have to figure this out. When you look at the industrial sector, that's clearly most exposed. Trade in America, about 40% of all trade or imports to America comes from Asia. I'm changing the way I'm saying that. It's not just China, it's Southeast Asia as well, 40%. That's high, but you look to the West Coast, you're at 70% of goods traded and imported come from Asia. So that's most exposed. And in the industrial sector, in our pool of assets, one of the deepest pools of private real estate assets in the world, you're seeing industrial activity, bidders show up, declining, and you're also seeing prices readjust, particularly for lease agreements that are pretty short. Now, what's going to be most insulated? It's most likely going to be multi-asset. We've had a structural housing shortage, but now higher tariffs most likely will be passed on to the house price. Best estimates, maybe 10% increases in home prices. You're talking about the most unaffordable housing market since the 80s again. So where does power restore? It restores back to owners of real estate. And multi-asset seems most insulated for me.
Let's just talk about owners of real estate and where in real estate you do and don't want to be.
Yeah.
Typically, when we talk about real estate with someone who's got exposure to real estate, they'll say it's great right now, everything's okay, and we're not marking anything to market. But at the moment, you can see some people are pulling back. Sure. Data center investment is something that comes up repeatedly, and we've seen example after example of tech firms starting to pause, starting to reconsider. Yeah. Are you seeing the same thing?
The data center investment strategy is so concentrated for many, many reasons, but predominantly because the amount of capital outlay that you need to put, there's only a select few people in the world that can do that. And that might feel good as you're the only person who can buy or invest in this, but it also means you can't sell it. For investors, you have to give liquidity, and that becomes a real challenge. Then you have your point on technical obsolescence. When you look at traditional industrial buildings, let's just make the numbers round. $100 per square foot for an industrial building on average. Great. A data center, you're over 3 times that. So where is the value? It's not in the real estate, it's in the tech inside. And I don't pretend to know how the tech inside of that will really play out. So tech obsolescence becomes a big risk. We don't own data centers in our portfolio for this reason, predominantly, but it doesn't mean there's not value in those. But being dynamic and being a tech investor, I think, has to be a critical piece of that. And I don't have that expertise on my team right now.
Final question.
Yeah.
You've seen a lot, been through a lot in your decades on Wall Street. How different is this time?
I don't think Wall Street is prepared for what is happening right now, in that the traditional portfolio allocation that everyone that comes and sits in the seat talks about is predicated on the 60-40 as the perfect portfolio. Now, that doesn't mean you rewrite and throw out the script. I'm not saying that. but the reason you bought things has to be different. And it's mostly, I think, in that 40 portfolio where the bonds that you're buying, they're not giving you diversification in income as they have for the last 25 years. It's just not happening. So you have to buy them more deliberately for this. And I think that diversification piece is changing. It's going to involve a bigger pool of assets.
I'm pleased you're pondering this because I don't think enough people are. I think for a long, long time, decades, in fact, there has just been this relentless structural bid for US assets. And it's within the post-war system, and we're having a real rethink of that right now. In fact, the administration is actively challenging it. Increasingly, you're having those conversations with clients. They're receptive to it, that we are seeing this fundamental, profound shift, potentially, in our future.
The best chart to pull up is just the correlation stocks and bonds over time. You go back prior to the late 90s, stocks and bonds were positively correlated. So what happened? What changed? I think globalization changed, confidence in Fed independence increased. And now both of those things are being challenged. So you have to think things can change and reverse. And now it's helpful that people like me can sit here and say, it's been 3 years and it's positive correlation again. Like time starts to show it. I think this is the biggest challenge that, again, everyone on Wall Street is trying to figure out. If it's not that 60-40, what is the optimal portfolio? And it's an adjustment, I think, that's going to happen globally and also in these diversifiers.
Tom, appreciate your time. As always, thoughtful stuff. Tom Kennedy of JPMorgan. We're all on this journey together, navigating some big shifts potentially, and I stress potentially. Equity futures right now on the S&P positive by 0.7% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. The U.S. has set new duties as high as 3,500% on solar imports from Vietnam, Cambodia, Thailand, and Malaysia after a year-long investigation. That investigation found solar manufacturers were unfairly benefiting from government subsidies, selling their products to the U.S. at rates below the cost of production. A check on Verizon shares, those falling in the pre-market nearly 5%. It reported a larger than expected decline in mobile phone subscribers in the first quarter. The largest U.S. wireless provider also reported quarterly earnings that beat analyst estimates and said it is on course to meet its yearly goals. Amazon's web services business is pausing some data center leases. According to Wells Fargo, it's unclear if the pause is of concern or part of the flow of hyperscaler activity. AWS's VP of Global Data Centers wrote on LinkedIn that it has not changed its expansion plans. And that's your brief, John.
Danny, thank you. More from Danny later this hour. Up next on the programme, the morning calls, plus Tom Narayan of RBC with Tesla earnings on deck. Those numbers dropping later on this afternoon. From New York, this is Bloomberg. The opening bell about 1 hour and 14 minutes away. Going into that, your price action looks like this. Equity futures positive by 0.8% on the Nasdaq 100, up by 0.84. That's the price action. Let's get to your morning calls. First up, Goldman downgrading Macy's to neutral, citing macro uncertainty and cyclicality risk. That stock is negative by 0.5%. Your second call from Barclays downgrading Texas Instruments to underweight, saying tariffs are hitting the company from all angles. That name is down by 1.3%. And finally, Bank of America lowering its price target on Nvidia to 150, pointing to export restrictions on the company's H20 chips. That stock is doing better. It's up by more than 1%. Let's stick with the Mag 7. Tesla reporting earnings after the closing bell. Questions looming about the impact of tariffs. Tom Narayan of RBC writing, we expect Tesla to price tariff impacts to consumers, and as a result, we expect volumes would come down further in a permanent tariff scenario. Tom joins us now for more. Tom, welcome to the programme, sir. Welcome back. Thanks for making time for us, as always. Those numbers drop later on this afternoon. Just give us a preview of what you're expecting and looking for.
Yeah, like is always the case with Tesla, folks will look initially at the quarterly numbers and then wait for the earnings call and to see what the CEO actually has to say. I think it's going to be no difference today. Folks will look and see what the automotive gross profit margin is. I think consensus is like a 12.8%, which is pretty de-risked if you look at how it's been recently. We already have the delivery number. We know what they were. We know why what happened there. I think because of the de-risk situation, folks will want to hear about the commentary on the conference call and the Q&A, specifically about what's going on with the affordable car, right? The affordable model, we think, is one of the big reasons why the delivery number was low. Also, the production cut that they did for the Model Y refresh. Also, commentary on tariffs, big topic, obviously, and the robotaxi launch in Austin in June. So we think it's going to be more about the commentary there as opposed to the specific numbers hitting in the quarter.
Tom, the elephant in the room seems to be the future of Elon Musk. Do you expect it to come up on the call, and what kind of commitment do you think Elon Musk can provide?
Yeah, I probably will come up on the call. I don't know what he will say. The sense is that what they have been saying in the past, the entire management team, this is a robust management team. They're executing on a number of things. We just talked about a few of them. So I suspect the Wall Street community may not be as focused, perhaps, as the retail investor community may be, or the press on this topic. Focus will really be on strategy and what the company is planning on doing for the year, and the response to the tariff question, I would say, more so than some of these other topics.
Tom, though, when it comes to the Tesla brand, can you untangle Elon Musk to that brand?
Yeah, it's a great question. It has been a big benefit for years, right? Tesla doesn't really have to advertise as much as, let's say, a Mercedes does, which is like, what, a couple $1,000 per car, because it has this halo effect on the brand. Maybe that, maybe that's changed somewhat. But what I would just comment here is we're at the point where this is no longer a startup, right? It's half of the entire U.S. EV market, virtually, on sales per year. If you're in the market for an EV, that's half the market. There's a reason why people like the product. I've said this before on your guys' show. Like, people are going to do what's best for their families. If they're going to buy the best, what they consider the most established EV brand or not, that ultimately will drive the narrative. If this was maybe 10 years ago or 5 years ago, maybe that's a different story. The brand now is the product, I would argue, more so than anything else.
So is it fair to say you don't agree with Dan Ives, and I'm sure you've seen his comments, that Tesla is facing a, quote, code red moment? I like Dan Ives a lot, actually. But I would just say, look, if you're looking at Tesla, okay, as an investor, as we do, this is a tectonic type company, right? Well, I look at it in decades, not months. Certainly right now, there's so many headwinds, right? Tariffs is not going to be, it might not be that pleasant. Now, we'll see how that plays out, right? Maybe that's resolved in a few months. We don't know. But look, 10% of my valuation is cars. A lot of the headwinds we're facing now has to do with cars, including tariffs, affordable car, whatever political things are going on. But the reality is robotaxi, autonomy, FSD, that drives like 80% or something of my valuation. And these are all things that will play out in time. I'm more of a believer in autonomy as a big picture item. And then I go top down and I say, well, Tesla has a great product with FSD. And I think they'll have a portion of this incredible opportunity for the mobility industry. They won't be the only ones benefiting. So I'm looking at it kind of like a top-down approach. And I think, like, fine, yeah, sure, near term, there's a lot of issues here, obviously in the car business. But let's take a step back and appreciate what is about to happen to this industry when it comes to autonomy. I think it will increase the share of wallet that all of us pay for mobility by multiples. It's not box with wheels anymore, right? And now it's something that can change our lives. And they're in a unique position to capitalize on. Let's see if they will. There is a lot of open questions. I will definitely admit to that.
Hey, Tom, the question I always get from Bloomberg subscribers, whenever a Tesla bull comes on the program, they want to know, what would it take to make you bearish? Tom, what would change your mind on the name?
Yeah, I mean, we just talked about it, autonomy, right? A big bullish thing is unsupervised FSD. If they get that, it's the mousetrap, right? Nobody else has something as cheap as them. They get to dominate this market that could be triples or quadruples of what the auto industry is. Now, what happens if unsupervised FSD does not happen? What if there are roadblocks to achieving this autonomy world? What if there are other players that can do level 2+ as well as Tesla does? Now they lose that comparative advantage. So I think if there's an obstacle to them achieving their autonomy goals, that would be a bigger issue.
Tom, just quickly to look out beyond Tesla and look beyond the US car market, the US auto market, and focus on Europe just for a moment. I think Europe's going to be really interesting in the months and quarters to come. We talked a number of times together about how much capacity needed to be cut on the continent. And Tom, what we're about to see potentially, and neither of us know what's going to happen with tariffs in the next several months, the next several years, but let's just say they stay where they are. Tariffs go up in the United States, the walls go up, and you face this situation where China just aggressively pursues the US consumer, starts buying up plants and capacity across the continent, Tom. What's the prospect for that happening, and how under threat do you think some of the European players might be with that in mind?
Yeah, that's a story that you're painted, that's the worst case scenario. Certainly you would see consolidation happen, you would see brands going away, you would see the SAR level there drop by millions. Now, I do just want to note, remember, Europe is different than other countries where you do have national champions. You have governments invested into keeping these companies alive. So while, production may come down, deliveries from these companies may come down, I think the governments will do what they can to keep the national champions alive. They'll have to do JVs with the Chinese companies and produce in Europe. They'll have to increase production in the U.S., like we saw what BMW announced recently, that they're going to increase production in Spartanburg. So there's things they can do. Maybe the European companies won't be as robust as they are today in terms of how much they're producing. They'll have to partner with others. They'll have to shift. But I think some of them will definitely survive.
Hey, Tom, appreciate your view. Tom Narayan there of RBC. Looking ahead to numbers from Tesla a little bit later on this afternoon. That name in the pre-market is higher by 0.8%. Up next on this programme, we'll catch up with the former New York Fed President Bill Dudley, get his reaction to the pressure building on Fed Chair Jay Powell and the erosion of at least the perceived independence of the central bank, and then get the reaction on the bond market moves of the past 24 hours. We'll catch up with Michael Kushma of Morgan Stanley from New York. This is Bloomberg. The open about 60 minutes away. Equity futures at the moment positive by 0.8% on the S&P, on the Nasdaq up by 0.9. With that opening bout just around the corner, let's get your morning movers with Danny Berger. Hey, Danny.
Hey, John. In the thick of the earnings season, 3M reporting results a solid beat on this quarter and no change to their guidance for next. That on its own has allowed shares to move up 7.4%, though they did issue a caveat to that. They said that they could see an earnings hit of somewhere between 20 to 40 cents a share. That initially sent shares lower, but again, perhaps the positive results and the fact that they didn't necessarily bake that into their baseline outlook is helping us gain from here. We also heard from a lot of the big defense contractors this morning. Lockheed Martin, solid set of earnings, but different for Northrop Grumman. Those shares down nearly 9%. This is because of a cost overrun when it comes to their new stealth bombers. It's something that they've been putting a lot of money in, trying to get it up to the market sooner, but because of those costs, a big miss on their part, down nearly 9%. Finally, wrapping things up with GE Aerospace, another solid set of results. They also didn't change their outlook, and they said that that includes the tariff impact, and it assumes that they're not going to see any big changes to tariffs. I wanted to bring this one up, though. Shares are up 4.6% because Larry Culp, the CEO there, speaking in an interview with Bloomberg shortly after the earnings, saying that he met with President Donald Trump. He met with this administration and talked about the benefits of a tariff-free regime for this industry, saying that it could help the industry have a trade surplus. He said he was optimistic that Trump was receptive to that message. John.
Danny, thank you. Appreciate the update. That stock is up in the pre-market. Got a busy day of Fed speak coming up as President Trump continues his attack on Fed Chair Jay Powell. Michael McKee, our economics and policy correspondent, joins us now for more. Good morning, Mike.
Good morning, John. Ordinarily, this would be the kind of week where everybody would be paying absolute attention to the Fed because we've got a Fed meeting coming up in 2 weeks. But it's not clear that there's going to be a lot of breakthrough from Fed speeches to the overall investing community. We've got a lot, as you mentioned there today, and a lot this week. Not all of them are going to matter. We've got a couple of them who are off topic. They're doing sort of Fed Listens events, trying to figure out what people are thinking of the Fed these days. But there's certainly a number on policy. The issue is, are they going to be telling us something about what they're going to do, or are they going to get asked a lot of questions about Jay Powell and his future? Because that seems to be all anybody is concerned about at this moment. We heard from Austin Goolsbee on Sunday and Monday, and he said the same thing basically both days, that Fed independence remains the most important thing, that you can't have anybody doing a good job unless they are able to do the job as they see it. Now, none of this, as I said, has made an impression on investors in terms of the next Fed meeting. We are going in with a probability of 0 rate cuts. I think there's a 10 basis point chance of a rate move from the Fed. But what we will see is this weekend, the Fed blackout begins, and that might be what everybody is really looking forward to.
If the Fed meeting was tomorrow, Mike McKee, and the news conference was at 2:30 Eastern Time, I think we all know what the questions for the Fed chair would be. We had a movie. We saw the rerun of this just maybe a few months ago. I think it was before Christmas, where the president was asked directly about whether, the chairman rather, was asked directly about whether he could be fired, Mike. Do you think his stance on that, his response to that question might change?
No, he's absolutely certain. He made that clear last week. And when you talk to Fed people, they note that the Fed is structured differently from other agencies, and that they think they have a very good legal case that the president cannot fire members of the Board of Governors, and they're willing to take it to court to find out.
Mike McKee, thank you, sir, for the update. Here's the take from the former New York Fed President Bill Dudley, writing this. Trump's pressure on the Fed is counterproductive. Not only does it increase the motivation for the Fed to wait, but it also makes households and businesses more concerned about the inflation consequences should the Fed's independence come to an end. Bill joins us now for more. Bill, welcome to the programme, sir, and good morning. I want to pick up on the first part of that second line. Not only does it increase the motivation for the Fed to wait. Can you build on that a bit, Bill? Motivate to wait. Where does that motivation come from?
Well, the Fed's credibility is really important. And if the Fed is seen as sort of caving to political pressure, that impairs the Fed's credibility. And if the Fed's credibility is impaired, that's going to lead to higher inflation expectations. So, this is why the Trump pressure on the Fed is counterproductive. It's basically putting markets on edge. And we can basically see that just in the last 24 hours. Gold prices up, dollar weaker, bond yields up, at a time that people are expecting rate cuts. I mean, the market still expects the Fed to cut interest rates this year by 75 to 100 basis points. So we see the market response is they don't like the fact that there's this uncertainty about the Fed's independence. From President Trump's perspective, this is really counterproductive.
Bill, just to build on that, another way of saying that would be that when the independence of the Fed is threatened, the threshold to move is higher. They dig in. Is that a fair way of putting it?
I don't think it's so much that they dig in to be, stubborn. I think the fact is, though, that if the Fed's independence is under threat, if they move, then people wonder what's the motivation. Is the Fed moving because it's the right thing to do, or is the Fed moving because they're under pressure? And to the extent that people think that the Fed's moving because they're under pressure, that undermines the credibility of the Fed. And so the Fed has to take that on board in terms of their thinking.
So basically what you're saying is they cannot move for a while now, given Trump's ire, because it'll look like they would be placating this White House?
Well, it depends on the economic news. Obviously, if the unemployment rate goes up significantly, then the Fed's going to cut rates because there's not going to be any question about whether it was in response to President Trump's pressure. But if there is a question about why the Fed is moving, then the Fed has to take that on board in terms of their decision making.
What do you expect the Fed to do this year? Do you think they're going to have a bias towards which part of their mandate, inflation or growth concerns in the labor market?
Well, I think in the short term, they're going to have to be patient because obviously there's a lot of uncertainty about where we're going to actually land on trade policies and tariffs. Number two, the tariffs, to the extent that they do go up significantly, which seems likely, is going to flow into prices. And we're going to see some higher inflation data. And I think the Fed's worried about the fact that, missing the inflation mandate for the fifth year in a row could cause inflation expectations to become unanchored. And if that were to happen, that'd be terrible. One reason why things worked out so well over the last few years is that inflation expectations did stay well anchored. So the Fed didn't have to push the unemployment rate up to get inflation back down relatively close to their target. If inflation expectations become unanchored, the job becomes much more difficult. So the Fed has to be very careful not to act too prematurely, because if inflation expectations go up, their job becomes much more difficult.
Bill, 6 years ago, you wrote a piece for Bloomberg Opinion. I'm sure you remember it well, because it was controversial at the time. You said the Federal Reserve shouldn't enable President Donald Trump, that the central bank should refuse to play along with an economic disaster in the making. Does that apply this time around?
Well, the Fed shouldn't take politics into consideration in terms of their monetary policy decisions. They should do what they think is appropriate to achieve their dual mandate of stable employment, full employment, and price stability. And I think that's what they're going to do this time. I mean, I don't think the Fed's political at all, and I think that's completely appropriate. But the Fed has to be aware of the confidence that people have in the Fed and the Fed's ability to be independent. And to the extent that confidence is eroded, that weighs on the effectiveness of monetary policy.
Bill, just to bring that up again, do you not stand by that piece anymore that you worked way back in 2019?
I stand by it in the sense that the Fed has to do what they think is appropriate to achieve their dual mandate objectives. And if the administration is doing things that are counterproductive to that, then the Fed needs to take that on board. But the Fed shouldn't be acting in a political manner. The Fed needs to be completely independent of politics, and I think they are.
Do you think the Fed is completely independent of politics, given the fact that the Fed chair has been outspoken about the tariff regime?
I think the Fed chairman is just talking what everyone can see. I mean, higher tariffs are bad for prices. They're going to drive up the inflation in the short term. To not say that would not be credible from the Fed's perspective.
Bill, appreciate your time, sir. As always, Bill Dudley there, the former New York Fed president and, of course, a columnist for Bloomberg Opinion. If you are just joining us, this bond market has settled down. Bond yields on a 30-year down by 2 or 3 basis points, the 10-year down by 2, and a bit of dollar strength out there. Certainly yesterday, it was nothing like this. A lot of dollar weakness and the bond market selling off, yields pushing higher. To talk about that, Michael Kushma of Morgan Stanley joins us now for more. Michael, good morning. Good to see you. Are we getting to the point where you start to think about buying this Treasury market, or is it still hands-off, wait and see?
Well, if you step back a moment and think longer term, 10-year bond yields haven't been much different for well over a year. They bounce around a lot, but from 450 to slightly below 4, which we saw just right after Liberation Day, they bounce right back over 4. They get to 450 and they can't really sustain levels above that. The curve is a lot steeper than it used to be with 2-year yields where they are, where 10-year yields are. You would argue around 450 is a level which, given all the uncertainty, it is a safe haven in that sense, but don't expect yields to come crashing down.
Hasn't behaved like a safe haven, and it's the behaviour of it that spooks some people. You have down days in equities like the one we saw yesterday, and the bond market doesn't receive a bid. In fact, you see the opposite. You see the bond market sell-off, yields climb on a 10-year and a 30-year. A number of weeks ago, you could make a very coherent argument that I think most people would accept, that we were seeing trades unwind, things blow up, that push people out of treasuries. Can you still make that argument now we're moving out of that phase of the sell-off?
Well, I think it comes down to valuation, right? So think of bonds as a safe haven as insurance. And insurance can be expensive or it can be fairly valued or cheap. And bond yields get below to 4% or lower. They are not much of an insurance premium. You're just paying a lot for that insurance premium. And maybe it doesn't work that well unless certain things happen. But the very nature of the shock we're talking about in terms of a stagflationary shock and rising inflation undermines the ability of bonds to perform well. And similar to 2022, we had worries about recession and bond yields were not going up, with real yields were rising, as they've done lately as well. Risk premium rising on everything, including bonds. So it's difficult for them at recent valuation levels to perform well when equities do badly.
So what's the true safe haven right now?
Cash, and the market clearly thinks gold, things that were independent of things that do well with inflation. Policy rates are still high, 4.5% or so. That's still reasonably high by historical standards. So you get a reasonable yield on cash for now relative to other assets, and gold keeps doing well because it's the global alternative to the U.S. dollar.
When we see the dollar go down, we've seen the euro just on an absolute tear, which Jonathan has talked about a lot. The start of the year, everyone was talking about parity when it comes to euro dollar. At the same time, we also see a lot of flows into things like sovereign debt markets in Europe. Do you think that's a place that people want to continue to trade?
We've thought that Europe, in many ways, the flip side of the U.S., without retaliation, which Europe hasn't really done, that German government bonds in particular can be a safe haven because policy can respond positively to the negative shock of tariffs being imposed on exports from Europe. So the central bank can ease rates aggressively. The ECB could go back to zero interest rates. Inflation is coming down, not going up. Fiscal policy committees, all these things which can support the economy, support the performance of the Eurozone, and particularly the currency as well. And we know European investors have been very overweight at global investors in U.S. dollar assets, moving back to the euro. Euro goes up, ECB cuts more, and you cushion the blow.
How aggressive do you think the rest of the world will be with regards to rate cuts?
I think they could be very aggressive, depending on how it's going. Inflation is not really an issue in most countries, and we've seen that in Canada in particular, very linked to the U.S. economy, aggressively cutting interest rates in the past 6 to 12 months relative to the U.S., not just in anticipation of tariffs, but the fact that things were deteriorating at a faster pace than they were in the U.S.
You mentioned Europe. Let's talk about the ECB a little bit more. They reduced interest rates last week. That seemed to annoy the President of the United States at the time. I think it's continued to annoy him. We've said on this programme the biggest threat potentially to European price stability is actually Chinese exports. You just said that maybe they could go back to zero. Do you think that's possible?
I don't think it's possible, but it's possible in the sense it could theoretically happen, logically happen.
Of course.
But in practice, I don't think
That's what I'm trying to gauge, though. How deep do you think the rate-cutting cycle might be elsewhere? We're seeing a ton of dollar weakness starting to emerge, which certainly gives them the space to do that. And the disinflationary impact of Chinese overcapacity on the rest of the world with the walls up in the United States certainly gives them even more space to do that. So I'm trying to figure this out. We're talking about 150 basis points? We're talking about more?
We're getting closer to 2. We're one more rate cut. I think we're at 2. So I think 1.5, another 50, 75 basis points is certainly possible, depending on how this whole tariff situation unfolds. So again, the hard data hasn't really deteriorated anywhere. Sentiment data has deteriorated significantly. Some forward-looking orders data is weaker, but actual economic growth has not really been impacted yet.
But the soft data, we've seen it come in weak.
Absolutely. Absolutely. Whether that translates into actual weaker data, we'll have to wait and see. And a lot of that is confidence. Consumers change behavior. We saw that in Europe in 22, 23 because of the rise in energy prices. Consumer spending collapsed in Europe. That's the danger for the U.S., that we have an inflation shock through tariffs in the next 12 months, and U.S. consumer spending drops back significantly.
What would be the tell for you that the soft data has impacted the hard data?
It's the labor market. If the labor market stays reasonably firm, household spending will slow down. Not saying it won't slow down, but it won't get to precipitous slowdown such that you actually worry about negative growth. So a slowdown's okay. We get closer to zero growth. But if unemployment goes up, households really pull in their spending, that could be much more detrimental.
Michael, it's good to see you. Thanks for dropping by. Michael Kushma there of Morgan Stanley. The good news for you this morning, the bond market settled down, stable, yields lower across the long end of the curve. We're down 2 basis points on a 10-year, similar move on a 30-year bond. Let's give you an update on moves elsewhere and your top stories in your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Pope Francis's funeral has been set for this Saturday at 2 p.m. Eastern Time in St. Peter's Square. A viewing of his body will begin this Wednesday in St. Peter's Basilica. President Donald Trump said he and the First Lady would attend the funeral, embarking on the first foreign trip of his second term to honor the late spiritual leader. Elsewhere, President Trump says that U.S. Defense Secretary Pete Hegseth is doing a great job despite what he called attacks from disgruntled employees. Hegseth facing staff churn, a leak investigation, and a report that he shared sensitive military plans in another unsecured group chat. A former Pentagon spokesman says that the Defense Department has been overwhelmed by staff drama and turnover under the Trump administration. Harvard University is suing the Trump administration for freezing billions of federal funding. Harvard President Alan Garber says that the freeze happened after it refused to allow illegal demands to make changes to governance, discipline, and hiring practices, as well as diversity programs. Trump has accused Harvard of failing to combat anti-Semitism on campus. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead and look ahead to earnings from Tesla from New York. This is Bloomberg. Equity futures positive here by 0.9%. The opening bell is about 41 minutes away, and the Nasdaq higher by 1 full percentage point. Your trading diary looks a little something like this. A slew of Fed speak today, including Jefferson, Harker and Kashkari, plus results from Tesla after the closing bout. Tomorrow, Boeing earnings and PMI data. On Thursday, durable goods and another round of jobless claims, plus Alphabet results. On Friday, get another reading, UMich sentiment, the final read going into the weekend. Joining us now is Bloomberg's Ed Ludlow with a preview of Tesla's results. Ed, welcome back to the programme, buddy. Share with us what you're focused on later on this afternoon.
Yeah, I think most people are just bracing on who shows up, right? The version of Elon Musk that shows up to the earnings call. And it's not so much just that he's disconnected and focused on Doge and his work with the administration, but it's that he's critically important to the company. And I think most people just want to hear something, although, that's the joy of being able to track the average of analyst estimates, right? Like profit expectations have really come down in the last month or so. And we know that the first 3 months of this year was tough, but there is a lot of question to ask and a lot to quantify on how Tesla navigates this trade environment, because while it's insulated compared to other US automakers, it still has Mexico exposure, right? Simple things like the glass on the windshield and other integrated circuits from China that basic questions need to be asked about.
Ed, Dan Ives put out a note and said Elon Musk is Tesla and Tesla is Elon Musk. They're synonymous. But what happens when he does, in fact, leave his government job, leaves Doge? Is it a fact that he goes back to Tesla and focuses on cars? He has a number of companies he can go spend his time drilling into.
It's the perfect time of year to go trawling through 10Ks. Go to page 20 on Tesla's 10K that published in January and read the how important is Elon Musk this company graph, and it just gets longer every year. So they list all the other companies that he's involved in and say we are highly dependent on Elon Musk, but he also has obligations at XAI, Boring Company, and now the Department of Government Efficiency. What I'm hearing from investors is that there's this kind of split camp, right? So the Dan Ives note is very clear. Go back to Tesla, focus on Tesla. But there are many out there that think, actually, what he's more interested in is XAI. I'm hearing increasingly that he's very focused on XAI being competitive with OpenAI and Sam Altman. He's more regularly attending investor calls and, trying to finance the growth of that private company, having taken it through the sort of interesting financial mechanism merger with X. So what would happen there? But again, all we can do is play what's in front of us right now, and that's how does he discuss his role with Tesla on this evening's earnings call?
Ed, what changed? Back in November, this stock surged, and we had people coming on the program saying that there was this big halo effect from being close to the Trump administration. What changed?
Yeah, the Trump bump. I was looking at the chart, like November 15th, for example, was this day where we thought, OK, this is great for Tesla. Musk has made efforts to put Tesla in the spotlight, right? There was the pictures of the president with a Model S and then the president pledging that he would buy a Tesla. But there's also the reporting that Trump has differences with that cabinet, particularly on tariffs, right? And he has made the appeal, it is reported, to Trump to rethink tariffs. I think that people thought he would be more influential on policy, even though he has this sort of clearly demarcated remit with Doge. And now there are doubts about that, while at the same time, Musk is less focused on the running of Tesla. That said, John, as you know very well, like we say this every quarter, there are very capable people at Tesla in very important jobs running the place while he's doing whatever he's doing. It's not as if it's a rudderless company, but again, that key man risk is just so apparent.
Ed, looking forward to the coverage later on this morning, 11 a.m. Eastern Time for Bloomberg Technology, weekdays with Ed Ludlow and Caroline Hyde. Look out for that a little bit later, and then earnings from Tesla coming after the close. There's been a big shift in what his presence with this administration means for this stock, certainly comparing now to where we were back in November.
Everyone thought that the first buddy was going to have all this influence on the president, and as well as potentially it would insulate maybe Tesla. But Tesla's not insulated when it comes to things like tariffs. To Ed's point, yes, there's a lot of manufacturing in America, but even things like Mexico, they need to be worried about. And then this idea that you do have Democratic senators and congressmen and women coming out and saying, we're going to ditch our Tesla because we don't like what Elon Musk is doing at things at Doge, which is why Dan Ives, this long-time bull, is saying it is a code red moment. They want to get the branding of Elon Musk away from the Oval Office and back to Tesla.
Just a quick final word on trade. The clock is still ticking on this 90-day pause, this 90-day negotiation. Periodically, we hear some soothing words about India, then Japan, then India. Are you seeing any reason to be confident that we can secure some of these trade deals before that window closes?
Not a full deal. I think what you have to read the tea leaves out of J.D. Vance's meeting in India with the prime minister there is that they talked about a possible roadmap for a deal. And India has talked about the fact that they think they can ink a deal by the fall. Well, the fall's obviously not in 90 days. 90 days is basically just after July 4th. But what if they can get a roadmap? And then that would mean that they stay at the 10% base level, not the 20, 30, 60% that some of these countries are facing. So if everyone come out with a roadmap, that might be enough to keep the reprieve.
The clock is ticking. This is what Torsten Slok of Apollo had to say yesterday. If current policies do not change, then the probability of a US recession in 2025 is 90%. 90%. Let's see if those current policies do change. In the equity market at the moment on the S&P 500, we bounced back by 1% on the S&P, going into that opening bout just around the corner. A welcome move in the bond market. Yields just about stable on a 10-year and a 30-year. Yields are lower by 3 basis points on 10s. On 30s, we're down 3 or 4. And in foreign exchange, a big turnaround in euro-dollar. Euro-dollar yesterday with a big move in the euro's favour. The dollar hitting a new low for 2025. Euro-dollar down by 0.4% at 114.72. Coming up tomorrow, we'll catch up with Julian Emmanuel of Evercore, David Leibovitz of JPMorgan, Scott Kroner of Citi, and Torsten Slok himself of Apollo from New York City. This is Bloomberg.